And good morning, ladies and gentlemen. Josan, ni hao, and daiga ho. Welcome, ladies and gentlemen, to the Global Financial Leaders Investment Summit, Conversations with Global Investors. I'm Andrew Work, and I'd like to welcome everybody to today's summit. Thank you very much. Ladies and gentlemen, from the beautiful Palace Museum at the West Kowloon Cultural District, we have moved the action across to the Four Seasons Ballroom here on the Hong Kong side of the magnificent Hong Kong Harbor. And today we are extending the conversation about the always complex issue of where and when to invest money. However, in the modern, complex, challenging environment that we face, we are now required by our investment partners and a myriad of stakeholders to also justify the how and the why of how we invest beyond making a simple return. Now, three organizations that consider these issues very deeply are our hosts today: the Hong Kong Monetary Authority, the Securities and Futures Commission of Hong Kong, and the Hong Kong Academy of Finance. They consider these issues deeply from the macro global view all the way down to Hong Kong's role as an IFC. And they avail themselves of the best minds on the planet to consider these issues and how to execute their mission. And today in this room, we have many of those great minds. And to welcome them and encourage them, we would like to welcome the Chief Executive of the Securities and Futures Commission of Hong Kong, Ms. Julia Leung. Please take the stage. Thank you.
The Honorable Mr. Paul Chan, Eddie, distinguished guests, ladies and gentlemen, a very good morning. On behalf of the Securities and Futures Commission, the Hong Kong Monetary Authority, and the Academy of Finance, I would like to extend a very warm welcome to all of you, especially those who have traveled far and wide to come to Hong Kong and staying for the second day. For many years, researchers have been tracking the world's economic gravity, noting that a progressive shift to east. The shift began to accelerate 20 years ago, pulling the center of gravity towards this part of the world, Asia Pacific. Today, the center of gravity in asset management has, without doubt, moved to this very room in Hong Kong. To put it in numbers, our speakers today manage more than 20 trillion in AUM, US dollar. This is not counting the AUM of this audience. This speaks volumes about the pool of this summit, as well as a major financial event of Hong Kong as a global asset and wealth management center. The theme of the financial summit for these 2 days is living with complexity, which this audience know all too well. In fact, we speak of complexity in plural terms, and as recent global events and new layers to the already complicated landscape for money managers and investors. The macro trends were explored yesterday with our speakers, so I'll just check off a few on these key events, key factors to kick off today's discussion. First is reversing the lower for longer policy expectations for the past decade to higher for longer. It was as if the word easing has just been thrown out of the window as the US dollar marched to a 20-year high. The interest rate cycle may be on its last legs, but it's for how high and for how long remains an open question. Second is deglobalization. This reverses globalization, which had been a deflationary force for the last 2 decades and lifted China to be the manufacturing power hub. It also kept prices and costs stable worldwide. Where inflation would land post-globalization is an open question. Third, the disruption to global supply chains is accelerated by geopolitical tensions, which conflate national security concerns with trade frictions and technology competition in an increasingly divided world. A common thread running through these themes is an undercurrent of political fragmentation. This drives the political parties, societies, and people in general far apart towards the two poles of the political spectrum, squeezing the middle ground for consensus building. And this state of political divide is not conducive to resolving a slow-burning crisis, but nonetheless existential threat of our time, and that is climate change. This will take decades of united global action without delay from all of us, including the money managers in this room. Potentially, another existential threat to human beings is AI innovation, but it also is a big opportunity for those who participated in yesterday's discussion. On this, the global leaders have just met and agreed to regulate, while financial regulators are like ourselves, we welcome the use of innovation, but only responsibly, and we're thinking of how to mitigate that risk. We are at an important inflection point in history. In the work of Ken Griffin yesterday, he said, and I totally associated with it, we've seen more crises in the last few years than all of our career. But as the good old Chinese saying said, 危中有机, which means in every crisis lies an opportunity. If not properly managed, risks will put you in the red, but certainly put you out of existence in extreme cases. But harness it well, you can turn risk into a boom into your business. Such is the state of affairs in this complex investment landscape. And yesterday, bankers talk about change in business model. Today, we have a room full of seasoned asset managers gracing us with a wealth of experience to untangle this complexity, forge consensus, and navigate uncharted waters. Together, we will apply the Chinese wisdom of turning a crisis into opportunities through new asset allocation strategies for public or private market, active or passive, Asia Pacific or elsewhere, green or different shades of brown. We will also map out a course for the future of finance and learn the art of risk-taking in this not too simple world. So let us begin. Thank you.
And thank you very much, Julia, for kicking things off. I'd like to welcome to the stage our next guest. Note, he has been hugely sought after from Hong Kong FinTech Week right through to our summit. Ladies and gentlemen, we now welcome to the stage the Financial Secretary of the Hong Kong Special Administrative Region of the People's Republic of China, the Honorable Paul Chan.
Eddie, Tim, Julia, distinguished guests, ladies and gentlemen, good morning. Very glad to see you in the second day of the Investment Summit. And welcome to the session on conversations with global investors. We all know the complex and challenging investment environment facing us today. Julia has already alluded to this in her address just now. And in such circumstances, investors tend to be risk-averse. A decline in risk appetite often goes hand in hand with reduced investments. Yet whether this conventional wisdom would necessarily mean good yield is questionable. It may work from a short-term perspective, but I would argue that it may not be so in the medium to long term. Look no further than Hong Kong for a case as testing to this. The cycles that Hong Kong has gone through in the past have all confirmed one thing. Our unique advantages have remained throughout, and each time we have come out from a challenge with new strengths and opportunities. So at a time of increasing complexity and uncertainty, Hong Kong presents a window of enormous investment opportunities with great potential returns. Let me explain. Basically, 3 points. New technologies. Innovation and technology. Hong Kong is determined to develop innovation and technology as a core engine of our growth. We released the Hong Kong Innovation and Technology Development Blueprint in December last year, outlining our vision, clear development direction, and roadmap in this important area, and have put money to where our mouth is. Our government has been the biggest investor in this area, investing over 200 billion to build, consolidate, and enrich the innovation and technology ecosystem in recent years. Despite the challenges we face, not least the geopolitical situation, the innovation and technology ecosystem in Hong Kong has grown more vibrant, with exciting achievements in nurturing startups, attracting enterprises and talents, and realizing the transformation of R&D outcomes. Take artificial intelligence as an example. It is fast developing and driving revolutionary changes to financial and other businesses. But it is data intensive. Many mainland AI firms are keen to come to Hong Kong because of our unfettered access to international data and information. But so would many international AI companies, because they will be able to access mainland data here in the future. With the support of the central authorities, Hong Kong is actively working towards cross-boundary data flow within the GBA, Greater Bay Area. Such convergence of data is not only benefiting the AI industry, it will also be conducive to the development of other sectors, such as pharmaceutical and biomedicine, for which data is an essential ingredient for R&D. In fact, many foreign pharmaceutical giants and the future stars of the industry are highly interested in setting up their R&D facilities in Hong Kong. For example, AstraZeneca will expand its R&D center in our science park. And it is our vision to develop Hong Kong into a health and medical innovation hub. Tech companies looking to Hong Kong also set sights on our world-class research capabilities and a deep pool of talent. 5 universities here are among the global top 100. We are also home to numerous award-winning scholars and researchers. Of course, tech companies at different stages are also looking to our vibrant capital markets, from venture capital and private equity to our listing platform, in order to realize their growth ambitions. You can reasonably expect that Hong Kong will give birth more unicorns in the next 5 to 10 years. Investment in companies with such potential are certainly good deals that investors should not miss. New modes of business. Technological advancements such as the development of blockchain have created new business models and disrupted traditional ones. We see transactional efficiency being significantly improved. Threshold for entering a market much lowered for businesses. As the second largest economy in the world, China not only embraces INT as well as digitalization at an unprecedented speed. The country itself has been a major cradle of breakthrough tech solutions and startups. With the unique one country, two systems advantage, Hong Kong can provide investors a second-to-none platform in observing firsthand and up close the rapid development of technological R&D and application in our country, gaining deeper insights into the new models of business, and at the same time, staying connected with the international market and capital, and most importantly, helping investors sourcing the right deals. Another game-changing trend that I would like to highlight is ESG. The transition to a lower carbon economy is irreversible, and this is a global agenda. Hong Kong is at the forefront of green and sustainable finance. We issue more than 1/3 of Asia's green and sustainable bonds last year. We are also making great strides in areas such as climate-related disclosures, green classification frameworks, green certification, and capacity building. But what should not be underestimated is Hong Kong's green tech powers. We have a vibrant green tech landscape with strong basic research and entrepreneurial spirit. We are already home to hundreds of green tech companies. Some of them are already selling their solutions across different parts of the world. With the respective strengths of Hong Kong and sister cities in the GBA, we will rise as an international green tech and green finance center, creating a complete financial and industry chain that will drive global green transition. New capital. Geopolitics may be posing challenges, but with challenges come opportunities. While some countries may be advocating reshoring, friendshoring, or even onshoring, many other countries, such as those in the Middle East and Europe, have actually been driven to diversify their investments to this part of the world. Here in Hong Kong, we are keen to capture such opportunities. Over the past year, Hong Kong team has been actively stepping up our collaboration with ASEAN and the Middle East, and we are going to see good outcomes. We will shortly be welcoming Asia's first ever ETF, investing in Saudi Arabia, to be listed here on our stock exchange. This is certainly a milestone signifying more two-way fund flows and an important step towards mutual market access between Hong Kong and the Middle East. Ladies and gentlemen, in a complex investment environment, the key to good investing is always to find new areas that have the best growth potential. And you are the experts. I'm sure Hong Kong and the GBA will offer you promising prospects and opportunities. And our Hong Kong Investment Corporation are very keen to work with you. I'm now looking forward to listening to your enlightening perspectives. Thank you, and I wish you a most rewarding summit and the best of health. Thank you.
Thank you very much, Financial Secretary. We are going to be bringing our panel up here, and these are conversations with global investors, and you can be part of the conversation, and I'm going to tell you how. On the back of the seats in front of you, unless you are in the front row, in which case it is right behind you, there is a QR code. The QR code is your pathway to putting questions to the moderators of our panels. So if you would like to ask a question of our panel, take out your phone, scan that QR code, and I recommend you do it early during the panel to have the best chance of your question being recognized by our moderators. Now, the pathway, the entryway, will be refreshed for every panel. So you will need to scan it at the beginning of the panel to ask a question for that panel. So just grab that QR code in front of you and get ready to be part of these conversations with global investors. And the conversation continues looking at the macro environment. When you are taking the view from 30,000 feet now, that view is frequently clouded by geopolitical tensions and uncertainties, domestic politics, and also what the economist calls homeland economics, a resurgence of me-first mercantilism that is undermining the global framework of free trade that took decades to establish. But to help us make sense of this and to blow away the clouds, we have an able panel to do so. It is going to be led today by our moderator, Julia Leung, the Chief Executive of the Securities and Futures Commission, if you'd like to join us. She is going to be joined on stage by Mike Gitlin, who is the President and CEO of the Capital Group. Here they come. Ann Richards, the CEO. Sure, let's hear it for them. Thank you very much, Mr. Chan. Ann Richards, the CEO of Fidelity International. We have Andrew Schlossberg, the President and CEO of Invesco, and Mark Wiedman, the Head of Global Client Business for BlackRock. And as they take their places, ladies and gentlemen, they're ready for action. And Julia, the stage is yours. Thank you.
Thank you. Thank you. I'll go straight into the panel discussion because we only have 45 minutes. I wish to leave some time for questions from the floor. You've heard me in welcoming remarks, ticking off some of these mega forces which are have a huge impact on your investment landscape. I'm a supervisor, so I don't envy you with like tens of trillions of money at your for deploying in a way which will generate that return. And yesterday, I've been dying to go to this panel because yesterday we've heard from a panel of asset managers and bankers. They tend to think that asset management is the next risk. I mean, the non-bank is the next risk. So here we are talking 30,000 feet, looking at the macro landscape, and we have all the geopolitics, the high interest rates. You are the money managers on the ground, deciding each and every day where to put that money. So I would just ask a common question to all of my panelists, which is like, what in the last 2 years was surprising in the mega forces? What is surprising, and what really makes you think hard about where to put the money? So shall I start with Mike?
Sure, thank you. And thank you for having us. We appreciate it. I think what we've learned over the last few years is that you have to be wary of consensus. So if you think back to the last few years, we had lower for longer, which has now become higher for longer. We had, and I think we have to challenge consensus as well. And so for higher for longer, we have a whole generation now of finance investment professionals who only grew up in what I would call a more abnormal period. So if you look for the last 25 years, this group has seen the dot-com burst. They saw the global financial crisis. They saw quantitative easing. They saw supply chains close with COVID. And all through that, they don't really know what normal looks like. There was one 5-6 year period of what I would refer to as normal as it relates to interest rates, and that was after the dot-com and before the GFC. You had the 10-year U.S. Treasury yield between 3.5% and 5.5% for 6 years. Outside of that, it's been very abnormal. It is abnormal. Just 3 years ago, we still had $18 trillion of negative yielding debt. That is definitely abnormal. And so when we look forward, and if you look from 1958 until the global financial crisis, the average 10-year Treasury yield was 4.75% when inflation was around 2 to 2.5%. So where are we now? Well, the 10-year U.S. Treasury yield is somewhere around that average, and maybe we have a period that looks a little bit more normal, and we don't have to identify necessarily the next crisis, but get settled into a period of time that doesn't have dramatic extremes. And the only other thing I'd say is this concept of deglobalization I would challenge as well. I think of it more as reglobalization. And if COVID and geopolitics taught people anything, it was diversification of supply chains. Everyone in the world is doing that. That doesn't necessarily mean massive reshoring. It means finding other places where you can find partners around the world. So I think we're a little negative on the deglobalization concept. It's more diversification and reglobalization.
I like contrarian views. I think yesterday Vice Premier He also told us to make new friends. So you actually on the same theme. But yesterday we heard that there's no alpha in public market. So are we seeing the asset management industry coming to a growth bottleneck in terms of AUM and profits over the next few years? So what is your strategy? You're very good in contrarian the views, but what is your strategy in creating value for your customers?
Yeah, the panels yesterday were fantastic, by the way. That doesn't mean every single fact you heard was true. And so I want to debunk some fake news that you heard yesterday. In the alternative credit space, there is a mindset that public credit can't generate alpha. So if you look at and this is not a Capital Group pitch, but it's a fact. If you look at our 10-year public credit, this is investment grade credit, our team has generated 97 basis points annualized of excess return through 2022. And so that is almost 100 basis points of excess return in the public credit markets. So just because someone says something doesn't mean it's true. That is a fact. And so I think it's important to know that facts are critical, and our team is able to do that in equities and in fixed income. And there are plenty of managers who are active who can generate alpha and not just beta.
Yeah, well, that is true. I will reduce your advertising time for Capital Group.
Can I add a comment?
Andrew, yes.
So just to pick up on what Mike said, so he's not a lone voice here. I think the issue is not active or passive. It's both, and privates and publics, and I think it's both. I think our biggest issue is there's too much cash on the sidelines, and what are we going to do to bring it back into the marketplace?
Thanks. Anne, what is your take on the macro forces? And you've heard the global bank, one of the global bankers was saying that the next crisis is in the non-bank.
Shock horror, bank says next crisis isn't going to be in banks. I mean, you know, I don't think that surprises anyone. So look, I'm going to pick up on something that Mike said and in terms of what is normal, where do we find normal? And I think there's, just to be a little contrarian, I think there are two things which have changed. One is global demographics, and I do not think our economic models have yet got to grips with the fact that the global demographic and the shape of the global demographic over the next 20 years is going to be very different from the one over the last 20, 30, 40 years. How does that feed through into demand side, all of that kind of thing? I don't think we have got anywhere close to getting to the bottom of that. So I think that is something that is different. What that means, whether that's inflationary or deflationary, find me two economists, I'll find you three views, but nonetheless, I think that is something that we need to really factor in as we go forward. I think the other thing that has changed meaningfully over the last 20 years or so is the interaction between fiscal and monetary policy. And I think you've seen governments leaving much, much more to central bankers to sort out, with consequences for their own finances. And again, how that plays out, I think, is going to be quite different going forward. And I think there are some quite tough choices that have to be made, which will then have ramifications for what the investment horizon looks like. But then to sort of pull it back into specifically what the implications are for our industry, if you think about what we try to do, we try to provide the bridge between the underlying growth that comes through corporates, whether it's through their debt, whether it's through their equity, but that attachment to the real economy. And we try and marry that to what individuals, whether that's through an institution or directly, to what their aspirations and needs are for their whole of life savings, whole of life investments from cradle through to grave. We try and be that bridge between the real economy and what individuals need over and above what they gain day to day when they work. And so if you think about that as the purpose for our industry, yeah, we have to adapt, we have to change to what is going on in the real economy, and we have to reflect that. But fundamentally, that is what our industry is there to do, to be that bridge. And whether you do that through a mutual fund wrapper, an ETF wrapper, whether you do that through active, through passive, through debt, through equity, fundamentally, we are the glue on the connectivity between what is going on in the real world and the long-term wealth aspiration, retirement savings of the population at large. So we have to keep adapting what we do and shaping what we do to what is going on in the real economy. And I think that that is the challenge for us, but it's also the opportunity for us.
Just a quick follow-up question. As you talk about there is more integration or marrying of your monetary tools with your fiscal tools, but now that with it looks like the lowering interest rates, which had been the formula in the last 20 years to solve a crisis, is no longer there because of inflation. So going forward, do you think that we are able, I mean, your ability to reflect on these real economy and provide what is needed, how do you think that in interest rates and how long, I mean, how transient or how permanent would these high interest rates be?
So I think what you have seen is that the transmission mechanism, and particularly in the US, has acted with far less speed than has historically been the case. So the inflation was much slower to respond to a higher interest rate environment, and actually growth, activity, was slower to respond, particularly in the US. Actually, it's worked a bit better, probably in Europe than it has in the US, but then the banking sector still has a greater role, for the reasons we heard yesterday, in the transmission mechanism in Europe. So I think it has been slower, but I think we would argue that the transmission mechanism hasn't in itself been broken. It's just been pushing on a piece of string rather than pulling on a piece of string. But ultimately, we have succeeded in moving it a little bit. If you look at the most recent data, you can sort of see finally the transmission mechanism is working, inflation is beginning to move. So I think that it is still there, but in this environment, particularly as you head into the political cycle that we are going into, I think it's going to make central banks globally, but also in the US, wary about doing anything too suddenly on anything. So I think this year will be a year of cautious policy, which probably does mean higher for longer, but with less likelihood of big jumps in either direction. I think that is probably because of that cautiousness in an election year.
Yes, of course, a vote of confidence in our central bankers. Andrew, back to you. You mentioned cash. There's a lot of cash on the sidelines. So what is it that you're doing with it?
Well, I did mention cash on the sidelines, and we represent shareholders around the world, so maybe I'll just comment what they're telling us rather than what we're doing with the cash. And this is more wealth management, wealth advisors, individual investors around the world, in particular in the developed markets. Something like a third to a quarter of their portfolio is in cash or cash-like instruments. And for the reasons Mike and Ann were both already covering, the interest rate picture is one of them. But I think the comment I wanted to make was more around the geopolitics. And I think picking up on what Ann said, I think one of the greatest challenges we're seeing is the tensions, wars around the world is really playing on the psychology, we think, of individual and wealth advisors. And so not only does the interest rate picture probably need to get more clear, but also I think the political environment, which is going to be difficult. So what we're seeing is portfolios are really positioned in a pretty defensive way, and what it's going to take to get them off the sidelines isn't just interest rate policy, but really, I think, sentiment and psychology.
Taking both Anne and Andrew, it seems like it's your psychology. It's how we think about the global outlook that matters, and you're just the intermediary trying to deliver.
Well, I don't know, Anne, if you want to. Well, of course, we have our own positions. It's their money, and what they're doing with their money is staying in cash, and they're getting paid to stay in cash. And so what's the catalyst moment that's going to create for them to look at riskier assets? And that'll probably come first in the private and public credit markets. And picking up on what Mike said, it's both sides of that market. But really, they're looking for the catalyst moment. And it may be interest rate policy, but it's probably not political certainty over the next year.
All right, so waiting for that catalyst. So Mark, so what's your take? What is BlackRock's take on what's on this 30,000 feet and what is changing here?
Well, first, I want to say thank you for having us here. Thank you for this amazing conference, and also thank you for the privilege of operating here in Hong Kong. So I'm going to try to scale. Julia, in your speech up front, you actually anticipated all the big forces that we think are driving the economy. So I won't repeat them. What I'll try to do actually is put numbers on them, as to actually what matters for investors. And there are 4 regime changes that we think about at BlackRock that are actually driving where global capital is flowing. And when I say global capital, I'm really talking about the West and Japan. China is a very different story, totally different monetary regime, different trajectory. The first one is interest rates. There's about $4 trillion of cash that is sloshing around waiting for action. Now, when that happens is open for discussion. Peter Harrison yesterday talked about how long these cycles tend to work through. I think if you watch public markets, you get complacent that action happens quickly, but the reality is the real economy adjusts when you have to refinance. And so we don't know when that cash will come back in, but that is the first big overhang that clients talk to us all the time. The second big driver is we see is the transition to a low carbon economy. And right now, the world invests about $2 trillion a year in energy of all various forms. That number, we think, is going to go to about $3.5 trillion, and the mix will shift from about 60% green-oriented, renewable-oriented, to about 80%. So we're talking about roughly $2 trillion of incremental investment in the transition. That is a perfect pairing. Most of those are very long-dated cash flows. For example, the electricity you earn on your solar panels. Long-dated cash flows that marry very nicely with pension and insurance assets. And yesterday we heard correctly that the public markets are short on long-duration spread assets. So that's very attractive. The third one is Basel III, and this is what drives the growth of credit, is actually the shrinkage of banks. Western banks. We're not really talking about Japan or Asian banks. And the reason is Japan credit demand is very, very low, and there's actually plenty of capital in the Asian banks. But in the West, what we're going to see is $4 trillion, we estimate, is coming off of bank balance sheets over the next 5 years. It'll come off in the form of loan sales or securitizations. And that's going to end up in asset manager portfolios and ultimately in the hands of pensions, insurance companies, and wealth. So that's about $4 trillion, call it $800 billion a year. And then there's a lot of talk about, as we have been talking about, supply chains and geopolitical tensions. In terms of investments, not what's interesting to talk about, but investments, this is a much smaller number. Our guess is we're talking about $300 billion a year of capital moving. And the reality is, as a public investor, it's quite difficult to invest in Vietnamese or Indonesian or even northern Mexican infrastructure, which is where a lot of that capital is flowing. So actually, if we were figuring where to pay your attention, it would start off with, when does the cash come off the sidelines, as you were just saying, Andrew? It's about the transition to a low-carbon economy, which is a long-term secular shift, very capital-intensive. And then third, this 10% shrinkage of bank balance sheets that we anticipate in the West.
So, so both Mark and Andrew has talked about the cash and the cash on the sidelines. So and this $4 trillion that's waiting to be deployed once the catalyst moment comes. So Mike, I want to ask this question. We've seen during the pandemic when interest rates were zero, investors would plow into tech and alternatives and private sector that you talk about. So now that we are nearing the interest rate cycle, the hiking cycle is nearing an end, how do you expect the alternatives, the private market to grow, or the tech stocks, which should be hit, suffered more from the high interest rates? Is it going to be the same more of this trend or other?
Yeah, when you look at the market, I think what people want to do is two things. They want to stay invested and they want to get the big things right. And so when I look at interest rates, and I think this is a really interesting conversation, I agree with Mark, when you want to own bonds is at the end of a hiking cycle. So the window really opens from the last hike to the first cut is the window of opportunity in bonds. And the big move is the 500 basis points plus of hikes we've already seen. Trying to be smart on the last 25 basis points of hikes isn't a good business to be in. So trying to get the big moves right. What hurt people in 2022 wasn't credit, it was owning duration, because rates went up so fast. If you look at the forward market, the market predicts the Fed to cut by 75 basis points over the next 13 months. I don't know if that will be right or wrong. But the market thinks we're relatively close to the peak in developed market central bank hikes. If that is true and yields are high, you have an opportunity now to own bonds at 6, 7, 8%. Very similar, I'm guessing, to most people's long-term capital market assumptions for equities. So I do think that window's open, and I think that's an opportunity. I think the public-private debate, I'm not sure it's as much of a debate as trying to find an opportunity and how much you're willing to give up for higher expenses and illiquidity. And there's just going to be a portfolio construction impact to that. So you can't look at them in isolation. I think you have to think of these things in terms of portfolio construction, whether it's active management, passive management alternatives. How do you think of a broad portfolio solution, and what's the liquidity profile of that portfolio, rather than an either-or conversation?
Right. You touch on passive and active. Now, Andrew, yesterday we heard that the passive, I mean, I don't know, this is one of Mike's comments, whether this piece of fact is true or not. Passives now account for like 40% of the turnover, and because of, and 10 MSCI stocks in the US account for the bulk of the market capitalization. But I think I've read somewhere that you have remarked that given the rise of passive, Andrew, then the industry is oversupplied with products and capabilities. So is that a view that you will, going forward, do we have that oversupply? And what do we do about that?
Look, I think we do. As an asset management industry, we have twice as many products for the retail and wealth space in the last 20 years than we have in the US 60% of the stocks. So something about that means we might be oversupplied to product. But I think it's more the emphasis, it's less on a passive active discussion. I think it's the emphasis on quality. And everybody here on the stage will talk about investment quality. And it's why we're especially happy to be here with this group, because everybody here is about investment quality. And it's also about longevity and taking long-term positions, making short-term fluctuations, but long-term decisions. The only thing I'd add to what was commented on yesterday, because the narrowness of the markets, whether it's 10 stocks in the equity markets, or it's people invested in their domestic economy only, or they're just in cash securities, is that the markets are way too narrow and concentration is way too high. And so I think there's plenty of product for people to go into. I think the work we need to do going forward as an asset management group, I think, and certainly as Invesco, is to make sure that we have high quality products. And I think something maybe we can talk about later, that we're set up for more personalization. So less packaged product and more people able to express their points of view in portfolios. I
think I've heard a familiar theme through all the speakers, that it's not passive versus active, it's not choosing one against the other, it's your choice, it's your prospect. But I would make it more pointed to Mark. How do you make, I mean, the audience in this room are dying to hear what's the next 3 things that you think that would be yield, that would provide the yields, which is better than bank deposits. So tell us.
Well, first, actually, you're part of one of the struggles that banks have is that the spread income that were addicted to when you could pay 0 basically and lend out at something is being compressed. There was a nice, lovely window where banks were able to pay 0 to depositors and earn like 4%, 5% on risk-free assets. And that's over now. And so the average deposit in the US, for example, has already gone up to 3. In Europe, a little slower because there's less competition from money market funds. But eventually that tension will lead to effectively NIM compression. I think what's interesting going forward in terms of long-term yield, Okay, I actually agree with Mike that the long-term, that picking exactly when to leg into long-term assets and particularly spread assets, that's a difficult game. But if you liked bonds, or even if you didn't like bonds back in 2019, you gotta love them now, because they actually, like, you can earn on the risk-free assets, you're earning a real return of 2.5%, and then from there you can just stack on that with credit. So now is a golden age for getting back into long-duration assets. Depending on your preferences, you decide whether to do it now or in the future, but that's going to be a bigger part of our portfolios going forward than not. The other big parts are private credit. I think whether it's insurance companies or individuals, that extra spread, assuming they can either match their liabilities or handle the illiquidity risk, that's another very attractive area. And then infrastructure. The world needs huge sums of infrastructure. I mentioned the transition, that's $1.5 trillion extra per year, but it's also aging societies, as Anne mentioned. All large economies are facing fiscal constraints. Everybody is going to have a problem with not enough workers relative to retirees. So the state is going to have a fiscal constraint on how much it can fund in infrastructure. There's only one place that can come from, which is actually from long-dated investors. So those are the areas we'd go. Bonds, especially with credit, private credit, and then infrastructure.
Good, a good list. And I'd like to turn to you for management skills. Now, as we said, we are seeing reversals of multi-decade trends. And you've written in an FT article, to maximize the chances of survival in a storm, 3 things are needed: a well-drilled crew in a seaworthy boat, enough life jackets for everyone on board, and the ability to swim very fast to the shore. Now, although you're talking about fintech firm, clearly, but I believe that asset managers also needs to translate that into, I said it all the time to the industry, risk management, contingency, planning, agility. So can you talk a bit about how, through these forces and changing in forces across Fidelity International, and what are the implications on the management skills, and what kind of people do you, how do you teach them? I mean, particularly when some of you were talking about they've gone through an era in which is low interest rates. I mean, how do you retune them into this, this new world?
Well, I think actually this is one of the most fascinating topics for all of us who invest in markets. And if you look at, before I specifically come back to Fidelity, just actually thinking about the businesses that we invest in and what we've been seeing, particularly out of the US. If you look at the earnings season this year, it's come through really strongly. Management teams in the last 5 years have been through an unbelievable storm where they have had to redesign, retool, reimagine entire supply chains, entire workforce practices. I mean, who knew that we could put global workforces in dozens of countries simultaneously into a working from home environment and keep our businesses going, keep the businesses that we invest in going, by the way, who've done the same. So I think you have management teams who have been kind of honed in a furnace to highly tempered steel. I'm probably mixing analogies horrendously at the moment, but you kind of get that. And I think you've seen it come through in corporate results. So don't underestimate the power of management who've been through a lot. Actually, their ability to pivot, to be agile, to reimagine stuff is probably better at this moment in time in just about every industry to any other time in history, because it's had to be. So when you then sort of pull back, what does that mean within our industry and within our business in particular? Asset management is a peculiar business because we have almost no pricing power at the revenue level. You try talking to a client about lifting fees, right? Not a conversation. You go into a supermarket, they lift fees they lift prices all the time. Really hard for that to happen in an asset management world. We rely on markets to progress, for our fees to increase, and yet our costs are very much baked in and are very much aligned to what's going on in the wider environment, because typically in our business, half or so of our costs will be people related, and those costs tend to move with the broader market pressures on pay. So in a low inflation environment with low interest rates and rising markets, that's kind of a sweet spot for asset managers. The environment over the last 3 years or so has been radically different. So we have to go through that retooling, that reimagining of all of the foundational pieces in our organization. We have to strip out layers in a way that we've never had to think about before. So we have to think of ourselves increasingly as first and foremost, as a data business. We have to think end to end in the processes that underpin that. So the investment that we are putting in a ton of that foundational stuff around data, around technology, is larger than it's ever been, and by orders of magnitude. And then similarly, our people, we have to get them comfortable with the ambiguity of the environment that we're operating in. People have to be comfortable with change, and that ability to pivot is something that we constantly reinforce internally. So it's kind of a combination of simplifying processes, getting the foundational piece right, and at the same time getting the psychology and the headspace right to be able to keep responding without getting fatigued to this very strange world, this new paradigm that we're all working in. And it's intellectually interesting, but it's not easy.
Any one of the our panelists would like to share their view on management?
Mike's got a new job.
Thank you, Mark. I appreciate that. So the one thing I would say, Anne's absolutely right. We do not control our revenue. There's a certain beta element to our revenue related to markets. We do control our expenses. And if you have the privilege to work at a private company, not a Capital Group commercial, just private public. If you have the privilege to work at a private company, you have to push yourselves to manage for the long term and not get into the cycles of management that you have to do as a public company. So when people evaluate your quarterly earnings as a public company, you'd prefer to meet estimates than not. When you're private, you have to say, where are our greatest opportunities that we're starving because of the current environment? And then push yourselves to invest in them so when you come out the other cycle, you've made progress. And that's something, it's hard to do in the moment, but you always, you benefit from it long term if you're able to do that. The other thing you asked about was about leaders. I think leadership is very important in all times, but certainly during volatile times. You want leaders who do two things very well: listen and learn. And Eddie does that very well. And HKMA, if you look at HKMA from 38 billion to 450 billion over 30 years, they've adapted. So you have to adapt and you have to listen and learn and get better. And I think that's important for any leadership group, wherever you are.
You're very good at advertising for HKMA as well.
Maybe just to add to Anne's comment on leadership, that was well said. The only thing I'd add is we all run global businesses here. And so I'd say the global connectivity, which over the last several years was challenging, and it is why, and thank you to the Hong Kong Monetary Authority for hosting us. It's why getting back together and re-engaging is important, and I think it's one of the things that got lost during the pandemic, obviously. So resilience is built over time, so is trust and teamwork. And being able to see up close and personal both our teams, but also the global economy and the global markets like we are today is really important.
Yes, Mark?
I just wanted. Hi. Actually, regarding leadership, I would recommend, if you haven't seen the panel yesterday from past and present HKMA leaders, it was a session. I actually was talking to Hendrik de Toit, who runs 91, about how showing this to our teams about institution building and vision over time. So that for me was the most inspiring panel from yesterday. I actually take a slightly darker view of the industry than Anne does. So to mix it up a bit, I think our industry has been sedated for 15 years by cheap money and 40 years of ever declining rates. Anybody who levered up with term financing looked like a genius over that 40-year cycle. You didn't have to do much. That's over. And I think that level of complacency is very difficult for organizations to shake absent a shock, and they haven't really faced a shock. I thought it was coming in March and April of 20 when equity markets were collapsing. I was like, uh-oh, here comes the overcapacity, it's coming out. Nope, we got that bailout. So I think we still struggle with that in all of our organizations. I know even, I've been reading Only the Paranoid Survive by Andy Grove again, and there's a passage in there where he talks about when Intel was facing the demise of memory chips. And he and his partner are saying, well, what would a new management team come in and do? They would say, we'd get out of memories. Why don't we do that ourselves? And I think that's something that every management team in the asset management world needs to, particularly in public markets, needs to be thinking, what is going to work for the next 20 years? Because it's probably not the stupor and the drug we got for the last 40 years of central bank pumping up of assets. Too bad. That was great, but it's over.
I love you, the way that you describe it. The central bank drugging you and sedating the industry. Right. Now, my question list is blinking and blinking, so our audience are actually had quite a lot of questions. I will take one from here, and if anybody is ready for the next one, I'll take the next one from the floor. This first one is, it's named, so I will say, so it's real. So it's John Orchard from Ohm Fifth. How worried are you about the US fiscal position and its debt sustainability? And what impact on the sovereign bond market and currency would you expect? So this is a timely question for November where there's a deadline for the debt ceiling. So who would like to take this? Anne is based in London.
You can't ask the one person not based in the US to answer this question, folks. Come on, get real.
It makes it far more credible.
I'll take it.
Mark.
Very quickly, the fiscal unsustainability of the U.S. right now is not priced into markets, and no one's really paying attention to it. And one morning, people are going to wake up and decide this is one of the most important forces in global capital markets. I don't know what will trigger it. It'll be something. And at that time, it won't be a funding problem. The U.S. government can fund in perpetuity. There are plenty of buyers out there who will buy treasuries. The issue is that it will reprice global capital. So yields will rise, and every asset in the world will be repriced. When that happens, I don't know.
Yeah, the other thing I would add to that is I talked about a generation of investors who are accustomed to the abnormal, not the normal. There's also a generation of investors who are predominantly dollar-based investors in their mindset. And I think we talked about diversification of supply chains and the concept of reglobalization. There's also diversification in currency. And I think there's an opportunity for the dollar-based investors to get non-dollar exposure. So I think you'll see more of that. The dollar was a one-trick pony in financial markets for a very long period of time. Having exposure to non-dollar either through global bonds or global stocks or trying to find a way to get that, I think will be a good thing as you look at any country's fiscal policy.
I'm just going to add one thing to that, which is, and going back really to what Mark said, which is a very important point. When you're the world's reserve currency, when you're the world's risk-free asset, I put that in quotes, the other side of that coin is it means you do rely on the kindness of strangers. And I think sometimes the US forgets that it relies on the kindness of strangers to keep the investment flows flowing towards its key markets in the way that it likes. And so I think Mark's point is absolutely right. There is a moment, if the US doesn't build that into policy, that there will be chickens coming home to roost. Yet another metaphor for you.
Andrew, you have anything?
I'll let Anne have the last word.
Always good to have a woman have the last word. Right. Any questions from the floor that would take precedence? Yes, please, this gentleman in the middle.
Hi, it's Freddie from Invesco. So this question is not for Invesco, but I would say hearing all your leaders highlighting a lot of macro landscape, but we haven't talked about China. So a lot of global firms are actually finding difficulties to navigate the game plan in China. So how do you define your own firm's success operating in China in the long run. So, anyone?
Maybe start with Mark. You have a China presence.
Okay, multiple of us have China presence.
Yes.
It's the second largest capital market in the world. Maybe one day it's the first. Long term has to be part of a global investor's portfolio. We also think there is a massive policy-driven shift in China to diversify people's retirement savings, which today are basically real estate and deposits, and in the future need to be more capital markets driven. So long term, those are big opportunities for us. Cyclically, this is a difficult time in China. Investment confidence domestically, I think people talk about China like US-China tensions are the driver. It's domestic policy, domestic investments are the driver of what we see as the long-term opportunities in China. Right now, cyclical challenges, but long-term, all of us, everyone understands that this is a central part of the global economy and global markets.
Mike?
Well, I think from an investment perspective, I always like it when you hear Fed speak and then people spend hundreds and hundreds of hours trying to determine what the Fed just say, and I always say what they just said. And so in China, if you're looking for long-term investing in terms of long-term policy makes sense. China economy is undergoing a massive transition that will take decades. And it's one from export-driven fiscal stimulus, land and property, to domestic consumption, domestic innovation, technology, energy transition. That, in an $18 trillion economy, that takes time. But if you're leaning into where the policy's going, you'll have a better opportunity to benefit from investing in those areas.
Anne, you want to add anything to it?
Well, I'd just say that I think when you look at the landscape, China and the Chinese economy is such a key part of the global economy. That is not going to end anytime soon. It's a key part of global supply chains. It's a key part of what keeps global capital flowing around the world. And therefore, I think a healthy Chinese economy is extremely important to the health of the global economy, to the growth of the global economy. I think the policy measures that were talked about yesterday, that we heard about, I think are important. I think the policymakers have been taking a very thoughtful approach to dealing with some of the imbalances that have grown up in the economy. But when you look forward, when you look at those global challenges around the climate, for example, China is absolutely a key part of the global solution to that. And I think that's what we stay focused on, in addition to the fact that in a market of 1.3 billion people with clear savings need for the long term, that is also part of where the flow of capital comes from to fund many of the other things that we need to make sure happens to keep the planet safe.
Am I allowed to make a comment? Yes. But I would just say I echo all the comments made, and China can't be ignored. And putting China's markets aside for the moment, I think, Anne, you were mentioning the quality of US companies through the last period of time. Seeing the quality of Chinese companies and the strengthening of Chinese companies to create more investable opportunities domestically and globally is going to occur. And so it can't be ignored, and the strengthening of the capital markets and the quality of the companies is going to create amazing opportunities.
Right. Any more questions from the floor? Here. Thank you.
Do you also work at Invesco?
Hi, I'm Jackie. I have a question. The Fannie and Bradlaugh also apply for support Bitcoin ETF from US SEC. Hong Kong is also the blockchain center in Asia. Will you invest more and cooperate in Hong Kong in the future? Thank you.
Here the question is the US regulatory environment for Bitcoin and cryptocurrency a bit different from that in Hong Kong. Here we have a regulatory regime, very clear guidelines. This is where I do my advertisement. Very clear guidelines on how to a centralized platform as well as intermediaries, fund managers like yourself in when you are dealing or when you are structuring a VA fund. So the question is whether, do you see that the client interest and whether Asia or Hong Kong is the place where you can pilot with some of these investments?
I'm happy to take that. So I think it's fascinating, and I think you have to separate crypto in its very narrowest form with what blockchain and distributed ledger technology can do underneath it. And obviously we have heard comments even this morning from Mr. Secretary about what the aspiration is for Hong Kong to do there. I think regulatory environments around the world, Switzerland, Singapore, the US, the UK, elsewhere, are wrestling with what is the right framework and what is the right toolkit to encourage innovation in this whole area, but without exposing consumers to inappropriate risk. And I don't think anyone has found perfection there yet, but I think this increased use of pilots, of sandboxes, of trying different things to work out which parts of the ecosystem get traction and then can be rolled out into scalable. I feel we're pretty close to the tipping point, and I think Hong Kong has a part to play in this, as do other jurisdictions. Nobody yet has won this. I think it's all there to play for.
If you don't want women to have the last word, Andrew, you can, or any of the men.
I'm going to say no again.
All right, very gentlemanly. The countdown is 0, so we're right on mark. So thank you. Let us give a round of applause to our distinguished speakers.
And thank you, of course, to our moderator, Julia Leung. Well done. If you would like to take a moment, we'd love to get a photo of this group at center stage. And Andrew Schlossberger, I'm not sure if he's gentlemanly or has been married for some time and knows when to let it rest. That could be. "27 years of marriage to Mrs. Work. I certainly know on which side of that divide I fall." And there we go. Thank you very much once again to our panel. Ladies and gentlemen, let's hear it for them as they exit the stage. Thank you. Well done. And we are now talking asset allocation. And asset allocation is about making the right choices at the right time. But of course, the question of how much to commit and for what term of time is getting more and more complicated as the world keeps throwing us surprise after surprise. Fortunately, our next panel coming up are expert investors who are going to be able to give us a really tremendous perspective on how they balance their portfolios from the near term to the medium term to the long term. They are going to be ably led today by Harshika Patel, who is the CEO of Asia Private Bank and the CEO of Hong Kong for JP Morgan. You can rally your troops and make your way to the stage. Following her is going to be, here they come. Yes, let's give them a round of applause to get them up here. Following Harshika, we welcome Howard Marks, who is the co-chairman of Oaktree. We have Ming Mei, who is the co-founder and CEO at GLP. Michael Sachs is the chairman and CEO, joining us all the way from GCM Grosvenor. And of course, we have George Walker, who is the chairman and CEO at Neuberger Berman. And with that, Harshika, are you ready for action?
I certainly am.
Take it away.
Okay, well, good morning, everybody. It's wonderful to be here today. And I have to say, I am superbly privileged to be sitting next to and sharing the stage with some of the greatest minds in the asset management industry. I think between their organizations, they run almost $1 trillion US dollars of AUM. And gentlemen, don't get offended by my next comment, but between them, they've chalked up almost 150 years in the asset management industry. So I really am looking for, they're staring at me now, or my career's not going very well. So I'm really looking forward to hearing their insights, how they've made it, and what's to come. But gentlemen, before we launch into the questions, I promised you an icebreaker. I didn't tell them what the icebreaker was, because I think it's very important that we all understand how they think before we get into the topic of asset allocation. So gentlemen, we're on a deserted island. There's one tree, and there's one banana at the top of the tree. And there's 4 animals who are competing to see who can get to that banana first. A lion, a giraffe, a squirrel, and a monkey. By the way, audience, feel free to play along. Who gets to the top first? So there's no right or wrong answer. So George?
I would say the monkey, because the both ability to climb and it's their natural food source. So
Thank you.
I'm along the monkey.
Okay. Michael?
Can I go last?
You're so,
I'll give my answer
they're a
now.
competitive bunch.
I think I would go with George on the monkey, but I think the lion ends up with the food.
Okay. Ming?
I always do the easy one. I just reach up as a giraffe.
Giraffe. And Howard, last but not least.
I would say whoever uses the most leverage.
Remember, you're sedated right now, so who would you go with?
I think the monkey.
The monkey. Okay, so ladies and gents, the monkey means we have a lot of deep thinkers on this panel. And Michael, you mentioned the lion, which means you've got the fighting spirit. And Ming, you mentioned the giraffe, so very logical. So a very diverse panel, logical, deep thinkers with the fighting spirit. So with that, I'm going to start off with my first quick question. Clearly, all of you have had an extremely successful career in the asset management industry. Howard, starting with you, when did you realize you were good at this stuff? And what was your differentiator? Because clearly back then, it was not the era of cheap money.
Well, I would say, I moved from equity research after 10 years. In 1978, I started up Citibank's high-yield bond operation. So after a half dozen years of results, I think I concluded I was okay. And
what was your edge, do you think?
Edge?
Yeah.
I think I understood that, well, I had adapted the policy that in fixed income especially, you win by not losing. And so, we now have a motto at Oaktree that if we avoid the losers, the winners take care of themselves. And that was roughly the period when I developed that approach, and I think it has worked.
And would that be your advice today, for someone starting out?
Well, that's great in fixed income. It's if you have strategies that aspire to higher returns than fixed income returns, then you have to move out in pursuit of winners. It's not sufficient to avoid losers, and so you should use a strategy or approach which is right for your asset class. But for ours, it has been.
Great, thanks, Howard. Ming?
I came from a pretty humble background, so ever since I was a kid, I was very focused on making money. And my goal in life was pretty simple. I just want to go and look and not worry about the price on the menu. But I think the turning point for me was when I realized that I'm not good at everything, and there are many people that are much better than me. And realizing it and accepting it was a turning point for me. And that's when I started learning how to leverage people and scale the business. I would say another lesson I learned is that it's much better to focus on 1 or 2 things for 20 years instead of focusing on 1 or 2 things every 2 years. And because it doesn't matter how stupid I am, the knowledge and experience they accumulated, that you become intrinsic, and the risk you can identify without even thinking. So these are the 2 things that if I start over again, I wish I can do it earlier.
So Ming, out of interest, what weren't you good at?
Actually, I don't make good decisions under stress. So that's why I leave the execution to others. I thinking more long-term that had no accountability.
Sage advice. Michael?
So I worked my whole life from the time I was a little kid with a paper route, and I had many, many, many jobs all the way, until I began a professional career. And a number of those jobs were jobs where very clearly the harder you worked, the better you did. And that was an important lesson for me. And I think that the differentiator for me was maybe a bit the culture and the frame and the values that we've operated the business with since the early 1990s, but work ethic. Where that came from professionally in the asset management world was being exposed to people early on who were clearly smarter than I was. So I remember distinctly meeting some fixed income arbitrage folks in the early 90s. They were math Olympians. They had 3 or 4 math Olympians at this little firm in a strip mall in New Jersey. I don't think I knew there was a math Olympics, okay? And I just distinctly remember coming out of this meeting and saying, wow, these people are much smarter than I am, but I can work hard enough to be successful, and I can lead a good business that gives good value and does a good job for our teammates and for our clients, and I'll be able to succeed by doing that. When I knew I could do that, I think we always learn more from periods of stress and loss. And so going through 94, 98, 08, you gain a confidence in your ability to do a good job for your clients. You gain a confidence in the resiliency of your business. And those were the periods for me when I got more confident in our ability to just keep doing a good job.
So, Michael, I did a paper round when I was 8, which was many years ago.
One of my jobs.
Well, can you remember how much you earned? Because I earned £3.75 for 500 papers.
I do not remember how much I earned. It was nothing. I mean, it was like, this was probably late 1960s, early 1970s. I do have a memory of how you would put the paper on your knee, have to hit it, fold it again, and then put a rubber band around it, put it in the basket on your bicycle. So I don't remember what I got paid for that. I know what I got paid for selling peanuts at the baseball games. That I can remember.
George.
I worked training monkeys. So for me, as many, I happened to end up at a school that had a really strong finance faculty, was really inspired by, touched by great teachers, and decided, that frankly through their influence became a real interest, and then had the privilege at working for Goldman Sachs for many years, and the opportunity to work with great folks in both a collaborative and a competitive environment was a special one.
Great, thank you. Okay, now we move on to the very serious questions. Howard, starting with you and Oak Tree, and this is a topic that you've actually spoken about quite a lot, which is clearly money managers make their money from insights, information asymmetry. Now, as we look at a world of data 24/7, being able to analyze that data very quickly in a world of generative AI, at Oak Tree, how do you manage this challenge of keeping on top of data and making decisions that other people don't have access to?
My son and I spent a lot of time living together during the pandemic and exchanging views, and he's a venture capitalist. And we distilled it in a memo I wrote in January of 21 called Something of Value, because it was of great value to live with him that period, but also most of what we talked about was value investing. And his conclusion, which he shared with me, which I accept, is that readily available quantitative information about the present cannot hold the secret to superior results, because everybody has it. Yep. And so if you start with that, I mean, it's a necessary thing to have and digest that information, but it's not sufficient to produce outperformance. And if you want to outperform in consequence, then what you have to do is you either have to be better than others at understanding the long-term significance of the data, or you have to be better than others at understanding the qualitative information about what you're dealing with. Maybe, I put a lot of stress on behavioral aspects, which of course you can't read on a financial statement. Or you have to be better at intuiting the future, one of those three. But, everybody in our business is smart and numerate and computerized. And so merely the manipulation of short-term quantitative information can't hold the key. So you have to get beyond the data to understand not what it said, but what it means.
So during the COVID era, where we had numerous lockdowns, how did you maintain that edge when clearly data is not the only thing that you use?
Well, at this point in my life, I'm not analyzing individual companies, but just read and read, be exposed to the media, talk to people, understand what's generally going on, and you can get a sense for whether markets are precarious or propitious. That's all you can do is, in my opinion, is get a sense.
So Ming, when we were talking earlier, we talked about your China business and how you're leveraging technology and data to see what's going on the ground with your logistics operation there. Can you tell us a bit more around how you're using technology and data today and how you see that evolving over the next few years?
So, for us, we invest in projects that need to anticipate what the world will be like in 20, 30 years. Because once you build a physical building, you can't tear it down 5 years later. So we have to anticipate how technology evolve and the location, and also the specification, how to accommodate automation and robotics. But more importantly is how does the retail pattern changes with technology. For instance, it went from mom and pop stores to chain stores to e-commerce to social retail, and then we probably eventually get into virtual, real world retail. So all these things, all these patterns, how does that change on consumption behaviors and patterns and locations and efficiencies? So these are things that we have to think about. And what we do is we use our private equity arm to invest in kind of what's around the corner. So to give you an example, there's one portfolio company we invest in that has sensors on 40% of all trucks in China that are running. So during the COVID lockdown, the central government couldn't get data from the local regional government, and they don't trust the data. So they asked this company to provide them real-time trucking activity on the ground, because if you just take away the service sector, the trucking represents the real economy. So they actually got a thank you letter from the Reform Commission from central government for them to react, because they need to have policies to react to which cities shut down, which road is shut down, and where the food are not being delivered and the necessity. So anyway, we use these data to make heat map and picking locations, but also understand this particular location, what's the value to that customer. So I'll give you an example. If this location is used by, let's say, Walmart to fulfill just empty stores at night, transportation cost for them is nothing because they're only making a few trucks. But if this location is used by an express company or a e-commerce company making thousands of trips, transportation cost is 60% of the operation. So where rent is only 20%. But for a Walmart operation, rent is 60% and transportation only 20%. I can take this location and give it to a frequent delivery customer, increase the rent by 20%, and they don't feel it. But if I push the rent 5% on Walmart, they experience, because of a much lower base. So again, this is a simple example of technology, and we actually use that for account receivable as well. If we see the activity of that customer going down, we know it before the CFO they're not doing well. We actually replace those tenants early on. So that's why we're able to, over the last 3 years, despite the economy not doing that great, our account receivable went from 30 days to 12 days today. So again, we're constantly turning and using this information to stay ahead.
And out of interest, where some of the macro headlines coming out of China look challenging, what is the trucking data telling us?
So, COVID hit in 2000. So 2019 was normal, and then what we saw based on truck data is that 2000 went down below 2019, but 2021 in China was normal. It actually, up till now, is still the peak in 2021. 2022 still haven't got up to 2021 yet, but interestingly, 2023 numbers starting in August passed 2022 by 4%. So, if you combine with energy consumption in China, that's about 4.5% increase. On top of that, you're seeing service sector consumption actually increasing a little bit. I guess the 5% GDP growth seems real.
Are the 23 numbers ahead of the same months in 21?
No. So we still haven't got back to 2021, but the 2023 numbers are above 2022 and above 2019 pre-COVID.
Wow, very interesting. Thanks, Ming. So, Michael, shifting gears slightly, Howard Ming talked about technology data. Let's talk about a topic that Ken and David Rubenstein touched on yesterday, which is talent. Right, so in this world of, everyone's super bright, everyone's got access to lots of information, everyone speaks 3 languages and is a computer scientist and an influencer. As you think about hiring at Grosvenor, what kind of people are you looking for? And in this era of whereby we're trying to hire for diversity of thought, right, how are you widening that funnel to get the best talent?
Okay, so a couple of questions inside of that. First, just with regard to DEI, I think it's clear to most business leaders now that diverse teams make better decisions. You have better ability to relate to your customers. You have better ability to relate to your opportunities, better ability to see your risks. So you want a diverse team, and I think part of the way that you get that is through intentionality, and you have to actually be intentional, and you have to work towards that and build that. That's been a constant effort for us for a long time, and we have very good results to show for that in an industry that does not have a tremendous amount of diversity in the workforce. I think in terms of the talent that you're looking for and how you think about sort of the evolution of talent in your organization, first, as leaders, you spend more and more and more time over the years on talent. We are, at the end of the day, very much people businesses. These are the assets of our firm, and it's critical to nurture, find and nurture and develop talent. So you spend more and more of your time doing that as you grow over time. I sort of think about things at a couple of different points. One, can people do the work? And that relates to some of the core capabilities and skills that you talk about. So can they do the work? And that's kind of the first hurdle or speed bump or what have you that people encounter. Then the next one is how's their judgment and their execution and their decision making, which is different from doing the work. And you have people that can do the work really, really well, but they don't necessarily get to that next spot where they're actually their judgment's fantastic or they're making decisions. And then the last piece I would mention is something that may be interesting to the group here. A number of us came into the industry before it was really institutionalized. And a lot of the people that you had speak yesterday came into the industry before it was institutionalized. The institutionalization and the growth, at that time, everybody had to do everything. You were proverbial chief cook, bottle washer. You were an investment person. You were a capital formation person. You were an operations and a regulatory person. You just had to do everything. And as the businesses have become institutionalized, people get slotted into specific roles, and they don't necessarily develop the skill sets outside of those silos. And we believe that for the good of our firm, and importantly for the good of our people, you really do want to have your investment people not just put capital to work, but also participate in capital raises and learn how to form, be competent with regard to capital formation and client relations. And if you're a young person, you want to do that for the future of your career. That's important. So institutionalization has brought some challenges with regard to developing complete kind of entrepreneurs who can lead business lines and grow businesses over time. And it's something I think you have to be conscious of and, again, manage with intentionality.
Thank you. So George, we've hired the people. How do we then pay them? And in a world, once again, where it's hard to make money, how do you pay your portfolio managers to make money in a differentiated way? And at the end of the year, do you look at process? Do you look at performance? What are the considerations that go into that decision every year end?
Happy to share how we do it. I think probably lots of folks in the room have lots of different models. Our model is grounded, our business is overwhelmingly an institutional business. So the clients are picking that particular team and investigating them and underwriting them. They're not just saying, you know, Neuberger Berman's a nice firm, let's just send them money. It's really grounded in the individual team. So as much as we can, we try and frame the compensation around alignment with the client. And so, frankly, firms that we look at and admire, many of whom are much smaller firms, and so we look at how would folks be compensated if it was a purely performance-focused partnership delivering for that client. So overwhelmingly, ours is primarily formulaic, linked to clients. If clients give them more money, our people get paid more. If clients take away money, they get paid less. And then we operate in a range around that sort of baseline, half of which is driven by performance, and we look first at 3-year numbers, and then at 5, and then at 1, and then half of which is driven by sort of citizenship. Are they a pleasure to work with and good teammates? But also, as we have important firm initiatives. So for a number of years, real focus on ESG and on engagement. Not just are you driving great returns, but we believe that owners in the equity business, for example, shareholders need to behave like owners. Are you engaging with company management teams? Are you writing letters? Are you writing letters to the board? Are you, can you demonstrate that you're being a good steward? More recently was a huge focus on data science and rewarding those teams who are leaders there in sending a message to those teams who are not. Now it'll be probably more focused on embracing AI and trying to help. Really what we're trying to do is to send a message that this is important and it will influence, but at the end of the day, the core of compensation is driven by client's decision. Is this the team I most want in the world to manage this particular asset for us?
And out of interest, are clients becoming more and more vocal about this topic in a world of higher rates, and therefore that additional alpha that they want you to generate suddenly, becomes much more emphasized?
I don't think so. I mean, clients have always been difficult and challenging, and it's a wildly competitive world, and always has been. So I think ours is a fiercely competitive business, and clients are demanding. But I think clients, at least from my seat, always have been demanding and engaged.
Howard, would you agree with that at Oaktree?
Well, we're like George in the sense that we're not asset allocators for the most part. We get hired to play a role. And, our clients, of course, they want good performance, but they also want interaction. And they want to know our thoughts, and they want us to help contribute to their decisions. So I think that client interaction is extremely important, and sometimes much more important than whether you were up 10 last year or 9.
Okay, interesting. So Michael, George touched on the important acronym ESG. It's an asset class that you said previously will become ubiquitous. Every high-quality portfolio should have some, et cetera, et cetera. In a world whereby the topic, particularly in the US, is becoming increasingly politicized, energy security considerations play a big role, particularly in this part of the world. And then when we look at ESG fund performance over the last year or two, it's underperformed the rest of the market. So with that backdrop, how do you still feel about, ESG becoming ubiquitous, and how do you think about it in your portfolio construction?
So I do think, I continue to believe that. I think it will become ubiquitous. Mark Rowan had a line yesterday, and I should just, I need to pause and thank HKMA for having us here, and Eddie, thank you. I forgot to do that earlier, but Mark, yesterday was a great day, and there was a lot of conversation that I found interesting and I found valuable being here. Mark's line yesterday, I think, was like, energy transition is going to, I didn't quite perfectly get the analogy, but it was energy transition is going to, consume more capital than the discovery of fire or something like that. And I agree that ESG will be ubiquitous. And what I meant by that at the time was I think there will be a day, and for some firms, some very good firms that have presented here, that day came 2 years ago, where when they make an investment, they have a plan for the asset they acquire that reduces emissions over a period of time. And there are terrific firms that had their leaders up here yesterday that have been doing that for years already. And every investment is accompanied by a plan. I think there will be a day when private equity does not buy a business without that business having a plan to bring emissions down by a certain amount over a certain period of time. I think the investors in these firms will want that more than those who don't. I'll come to that in a minute. And I think the returns will prove that. So $76 billion of capital that we manage, $25 billion is ESG or impact. That's not all energy. That's not all carbon. We're the largest investor with women and diverse alternative asset managers, I think, in the world. And that's part of our ESG capital. But I think that this will just become something we all do for return. And our $25 billion has grown not only because clients have wanted that, but because that's where our investment teams have deployed the capital. Regardless of the mandate, that's where they've felt the returns are. It was pretty amazing 2 years ago when the war in Ukraine started to see this very fast and very powerful pushback on carbon in the United States. You had 18 state attorneys general sign a letter that their states weren't going to, they were going to sort of look for people that were driving ESG, boycotting fossil fuels, and try to circle them and cut them off from the capital of their states. You had a couple of states pass laws. It became very politicized. It definitely slowed things down a bit. Doesn't change my view of where we're going, and I actually think there's a lot of leadership coming from right here in Hong Kong and Greater China to drive ESG, and I think that's very important for where we're going globally. With this political backlash, I would just share that for many, many years, we've operated portfolios in the diverse manager space. The states in the US have had very different constitutional approaches to that space. So you've had states where that is not allowed to be a factor for consideration, and states where there was an affirmative mandate to engage with women or minority-owned firms. And so I think whatever the political noise is, and some of it is, there's a lot of headlines there, there's some cheap opportunities for politicians, et cetera, but whatever that political noise is, I think we're going in one direction. I think it's a positive, constructive direction, and it's going to be a lot bigger part of all of our portfolios, whether we do that by mandate or simply based on opportunity.
And how are those portfolios performing without sharing any state secrets?
So our ESG and impact portfolios generally are performing, have performed quite well. Again, for us, it's ESG and impact, and it's a number of different strategies. Our diverse manager portfolio has tremendous performance in the private equity space, as an example, over a 17-year period of time.
Thanks, Michael. So Howard, I watched your interview yesterday with Bloomberg, and you said now's the time for credit. I think that's a view that you've been sharing for the last year or so in a higher rate environment. How do you feel about, well, clearly you believe that, but in a world whereby we have higher for longer, and potentially increasing signals of a recession. How do you square that circle?
Well, first of all, I don't think this is the time to invest in credit. This is a time to invest in credit. And on my annual trip to Asia, which was a year ago now, I put the finishing touches on a memo called Sea Change. And I think that we are undergoing and have undergone a sea change. Anybody who came into this business since 1980 has only seen declining interest rates and ultra-low interest rates. You have to go back to the 70s to have had a different experience, which most people don't do. But I think, and declining interest rates are great for asset values, and they're great for reducing the cost of capital. So by definition, they're great for people who buy assets with borrowed money. And we now have a lot of popular asset strategies which consist of buying assets with borrowed money. And they did well in the declining interest rate environment. You would have to have something wrong with you not to do well with a levered portfolio in a period of declining interest rates. But my essential message is that that's over. And, from the current levels, one of these days when we declare victory against inflation, the Fed funds rate will come down a little, but it's not going to come down another 2,000 basis points like it did in the last 40 years, and it's not going to be at 0.5%, which was the average from 09 through 21. So if you accept that the period of declining and ultra-low interest rates are over, then the strategies that did best in that environment are necessarily the strategies that will do best now. The key is today you can get equity returns from credit. And that changes a lot. 21 months ago, high-yield bonds yielded 4, and today they yield over 9. The 4 was not very useful. The 9+ is quite useful for my clients. It changes everything. And that 9 is the lowest aspiring of all our strategies. If you go into private credit and lock up your money for some period of years, then you get into the double digits and so forth. So I think this is, we went through a difficult period. I gave a speech for 8 years entitled Investing in a Low Return World, because that's what it was for credit or debt investors. But it's not a low return world anymore, and I'm very excited about that. And I think that credit, by definition, should have a bigger allocation in portfolios than it did in that period.
And Howard, for an individual, you've seen many cycles. Do you think a recession is looming?
A recession is always looming, depending on your definition of looming. There's always a recession ahead.
How about a one-year time horizon?
Well, John Maynard Keynes said we have two kinds of forecasters: the ones who don't know and the ones who don't know they don't know. And I am solidly in the first group. One of the tenets of our investment philosophy at Oaktree is that our investment decisions are not driven by macro forecasts. So I don't know, and it would be nice if I could know, but since I can't know, then I don't care about it. And we try to invest conservatively in high quality companies that will endure, and if we get that right, then it doesn't matter what kind of economic fluctuations we go through in the short run. The emphasis in our business on the short run is really excessive and in my opinion, immaterial.
Okay, thank you, Howard. So Ming, shifting gears from credit to your world, logistics, data centers, renewables, you're in 17 markets. Which markets are you most excited about? And of those 3 segments, which segment are you most excited about?
So, yeah, we're in 17 countries, but basically few major regions, because there's so many countries in Europe. I would say we started in logistics, and we're leveraging the knowledge in logistic warehousing to help our customers expand to data center, and then leveraging our roof to get into solar. And those 3 sequence, the largest still being logistic, and the second largest is data center, and then renewable energy. I would say if you give it long enough time, the size of AUM probably reverse over time just because the addressable market size. Japan has been our most profitable market for the last 10 years. It's amazing. Even last 10 years economy, we are still getting 40 to 50% IRR on our development program in Japan. It's, people say, hasn't Japan been a low growth? Every business is about supply and demand. And it's been limited supply, and the demand side has been strong in our sector. So unfortunately, the market in Japan is not only so big. So we can't place out as much capital as we want to. And I would say US market has been very strong for us. And I would say now, I think China, everyone's been so negative. Actually, I think it's oversold. I actually like it when everyone doesn't like something. So I always believe that there's a value for everything. If gold is good, but if you tell me $10,000 per ounce, it's not good. On the opposite of gold, there's a value and there's a price. So I always say, we always talk about risk. There's no such thing as high risk or low risk. Are you getting paid for the risk? So from that standpoint, I'm actually I'm probably more bullish on China than 99% of people.
Okay, thank you. So George, a topic that was discussed yesterday, and both camps were called risky, which is public and private investing. Neuberger is one of those unique companies whereby you've got material portfolios in both camps. How did you make that decision, given most companies are basically either in one camp or another? And do you see the public and the private markets converging at some point?
So we always looked at it as simply investing, and so what. And I think the world is coming around this way, and many of the folks in the room are public firms are racing to build private capabilities, build or acquire, and we've found great value in terms of having both. I think as for private market investors, understanding the public markets have never been more critical. And many of the skill sets we have in our public market teams, for example, in credit, has been incredibly helpful to our development of in the private credit market. And are seeing also more and more sort of institutional mandates that are these large, crossover mandates used to be adding high yield to a high grade portfolio, and now is instead means you decide where it goes across public and private markets. So it's a core part of what we do. We haven't struggled to have the disparate teams, and frankly, I think the opportunities to collaborate are very valuable. I also think investments that we make in things like data science and AI, many of which are driven from our public market investing, I think are going to be really differentiating in the private space as well. So I think these worlds are colliding, and that many of the firms today that aren't in both will be a decade from now.
Okay. So Michael, I saw you nodding as Ming was talking about, looking at asset classes, sectors, geographies that others may not like. Is there a particular sweet spot that you're looking at that others may not like, where you're spotting opportunity?
I think that our approach is typically to be pretty broadly diversified across, a number of strategies, and so I'm not sure that we think there's a unique overlooked opportunity that the crowd here over the last couple of days isn't familiar with. I think to Howard's comments, we've been increasing our allocations to credit. We've been increasing our allocations to credit broadly defined. As George just mentioned, we've been raising capital that is credit focused, but it has a broad mandate. You can go where you want in the credit markets with that capital. And we think that there's a better opportunity and to be doing that today than there was 2 years ago, obviously. And it's probably the first time in a while that we've been able to be excited about the absolute level of return that is coming from kind of credit-like risk, and that feels very good to us. So I don't think that's novel, and I don't think it's anything that's overlooked, but nonetheless, I think it's smart to do. And in general, everything we do is in the alternative investment space, both private markets, whether it's infrastructure, real estate, private equity, or in the liquid alternatives or hedge fund space. And diversified portfolio inside that universe has made a lot of sense to me for a long period of time, and it continues to make a lot of sense to me in today's environment.
Great, which then nicely brings me on to my last questions, because I'm conscious that we're running out of time. So gentlemen, put yourself in my shoes. I just turned 50 earlier this year. I've accumulated a savings pot, not from the paper round that I used to do. If I look forward 10 years, and I have a 10 years savings horizon, what should I put my money in? Howard?
Well, of course, there's no such thing as a one-size-fits-all answer, and it depends on your aspirations and your risk tolerance. I've got
a 5-year-old, so I've got some school fees to pay.
Okay, school fees to pay. Well, you know what? Obviously, I think that you can get very good returns with a high degree of certainty in credit. The bedrock for every portfolio should always be equities. You know, in the long run, you want to invest in the growth of the global economy and the performance of leading global corporations. And so you should never get away with that, get away from that.
Okay, thank you, Howard. Ming, your advice for me?
You should let me manage it.
Your management fees are too high.
No, you know, we focus on investing in infrastructure for a new economy, that things, you know, that last 20, 30 years. Because I always say, I am not smart enough to compete with everyone on the latest trend. So I'm focusing on investing in things that won't change the next 20, 30 years. So regardless, as long as there's population, there's consumption, and, you know, data is going to be driven by AI. There's AI everything, and then energy is transition. So these are the things that to 20, 30 years won't change. So I'm betting on these, you know, for the next 20, 30 years.
Great, thanks, Ming. Michael?
I think for most investors, prudence means that asset allocation needs to take precedent over security selection, and you need to have a degree of diversification in your portfolio for you to, you know, sleep at night and not make the wrong decision at the wrong time. And so from my perspective, you'd be diversifying across strategies. You'd certainly have long, you know, strategies that had residual long equity. I do think private equity, despite higher interest rates, will continue to outperform over time, over a long period of time, liquid equities. You maybe get some more adjustment in pricing, but once that market starts to open up and roll forward again, you're going to get good returns there, as you always have. Infrastructure, in particular, kind of new infrastructure, has you know, a lot of tremendous opportunity. And so to me, a diversified portfolio of the alternative strategies, if you're going to go get on a boat and sail around for 5 years and not want to worry about anything and not worry about checking on it, that's a great way to go.
Fabulous, thank you. George?
I would say my favorite trade or theme would be being a liquidity provider to private equity firms right now. Can be the secondary market, can be midlife deals and GP-led secondaries, can be co-investing, can be putting in preferreds into private equity deals that perhaps didn't do a great job of hedging interest rate exposure. So I think there are a whole series of different things around that theme that are just particularly attractive right now. So I put some in that, and then I put the bulk in a, you know, diversification notwithstanding, in a high-quality portfolio of small and mid-cap companies that are profitable, have low leverage, and solid market positions, sort of steady eddies, which are sort of unloved right now, and I think have a good shot at delivering a solid diversified return over a 10-year period.
Great. Well, thank you very much, gentlemen, for the sage advice. I'll be sure to speak to my JP Morgan private banker. So with that, thank you very much for your time. Audience, hope you enjoyed the conversation and enjoy the rest of the conference.
And thank you very much to our moderator, Hashika. Great job. If you wouldn't mind taking a photo with the official photographer, lady and gentlemen, before you leave the stage. Fantastic. And they got very in-depth into the conversation. Didn't have a chance to go to the iPad for the questions, but the interface with the QR code will be refreshed for each panel. So if you would like to bring your questions to the next panel, just wait a few moments, and then we will have it all lined up for the next panel as we go. There we go. Have a quick look at our people in the back there for your photo. There we go. And well done. That's a fine-looking group of investors. Ladies and gentlemen, thank you very much. And with that, we are going to consider, again, we're always looking to the future here in our conversations with global investors. And mega trends, whether they be physical, social, cultural, they intrude onto the world of investing. And sometimes really, whether it is ESG, it is technological revolution, or even changes in managerial thinking, they all impact how we do private equity investing. And fortunately, our next panel is very well equipped to deal with this and we're going to be having a discussion. Once again, I'd like to remind you to use the QR code that should be active now for this panel. Our group is going to be ably led today by Janet Paramel, who is a Senior Managing Director and Director of Investments, as well as the head of Hong Kong and China for Wellington Management. She is going to be leading a group. We are going to be welcoming Juan Delgado, who is the Vice Chairman at Hamilton Lane. Also joining us today, Janet, thank you very much for coming up, is Nate Sleeper. He is the CEO at CD&R, and completing our panel today is Mr. Hemant Taneja, who is the CEO and Managing Director with our friends at General Catalyst. So, ladies and gentlemen, and especially Janet, go for it.
Thank you so much. Good morning, everyone. It is a pleasure to be here, and I want to just say thank you so much to HKMA for a fantastic conference. There's been so much rich perspective, content, facts and opinions shared as well. So I'm super excited for this panel. From a private equity perspective, we've got multiple perspectives along the private equity spectrum, and I'm really looking forward to the conversation with these gentlemen. So getting right into it. The rise of private equity over the last 40 years has really coincided with sort of a long and gradual decline in the interest rate environment, as well as ample liquidity. So now we've gone from an essentially zero-rate interest rate environment and into something that's new to many. And then on top of that, you've got the geopolitical uncertainties, you've got changes in demographics, supply chain, lots of different trends going on. And so we're going to be keeping in the theme of what are these big trends that we're seeing for the future and how you're approaching it. So my overarching question is, how do you see this market regime changing the way you think about investing from your perspectives? And importantly, what are the new and emerging risks that you're looking to sort of think about as you implement your respective strategies? So I might start with Nate.
Okay. Thanks for having us here. I would say that the title of our panel is a little daunting. The future of investing in 35 minutes is a tough challenge. Clearly the world is an uncertain place. There's a lot happening from a macro standpoint. There's also, when we look at our businesses, we have 45 companies. Usually in more normal periods, our companies kind of move together, different degree of sensitivity to the economic cycle, but generally move together. Right now, because of the repercussions of the pandemic, kind of the post-COVID, post-stimulus, post-inflation, post-shortage unwindings, there's actually a wider dispersion of performance across our companies than would be typical. So clearly we're in an uncertain place. But I would say we're always in an uncertain place. It's just sometimes it feels really uncertain, and sometimes it is uncertain without us knowing it. And maybe by way of example, a little factoid around our own firm. I've been at the firm for 23 years. I've been on the investment committee for most of that. virtually every investment case that has ever come to our investment committee has had a IRR of 20 to 25%, like just every one of them. And the amount of effort that goes into that, from teams, months of work, lots of debate over small changes, consultant inputs, data from the companies, and so just an enormous amount of work to get that case really, really precise. Our firm's been around for 45 years. We've had exactly 2 companies that have been fully exited in that range. And so we get it wrong every time. We're always wrong. And we don't think we're bad at forecasting. It's just reflective of the fact that over a 5 to 7 year period, the future of the world is unknowable. And so for us, return generation, how we think about returns, that's mechanical. How we think about risk is really where the art of the investment decision is. We think about it, distribution of outcomes, how do we manage the downside risk, how do we emphasize the skew to the upside, and craft transactions that reflect that. You know, as we think about where we are now and some of the changes, the macro changes that we're talking about, transactions themselves will adjust, capital structures will adjust to the higher interest rates, the equity contribution will adjust. So the mechanics reflect the environment that we're in. I think private equity offers 3 things that are consistent. 1 is we have capital. 2, we have relationships and creativity. And 3, we have governance and operating capability. Capital in some periods can be really valuable, and some it can be a pure commodity without differentiation. Depends on the environment. Our relationships and our creativity, our ability to catalyze transactions that create value for all parties involved, for the counterparties, for our partners, and in so doing, creating value for the transaction that we're making, I think is a real key to what we do. And then finally, the governance structure that we bring and the operating capabilities is, in our view, a superior model over the long term to really drive business improvement. And so I think we'll adjust to those macro factors, and those things that are real advantages in our model are constant. So I think we'll adjust and continue to perform is my perspective.
Can I just ask, you talked about risks and to the downside, and I know we're going into a more uncertain environment. Are you doing anything different on the downside as you think through the risks?
You know, I would say our whole period is 5 to 7 years. I think Howard Marks said it, there's always a recession pending at some point, and certainly over that kind of time period, we always assume that we're going to be in a negative environment. And so we think about how do we structure our investments to be able to navigate the downturn? How do we identify operating levers to be able to navigate through that downturn? I think actually Eddie and Joseph Yam said it really well yesterday. Contingency planning is everything, and we spend a lot of time on fire prevention rather than firefighting. And so I thought that was a great framing, and we think about it the same way. So that's how we think about it.
Great. Juan?
Well, first of all, HKMA, thank you so much for having Hamilton Lane here. For those of us based in Hong Kong, as I've been for the last 12 years, we get to be in this ballroom often. I don't think I've seen so many people on a day 2 of a conference at the Four Seasons. So congrats. I'd say clearly we've had it very easy for a long time, and we've gone from easy to hard. But I think we risk overstating. We've not gone from easy to entirely unprecedented. You know, at Hamilton Lane, one of the things we have is data. We have over $16 trillion of private markets data. And that goes back not 1 year or 10, it goes back 50 years. So we have data from the 70s. There were buyouts in the 70s, not as many as in the 90s or 2000s, but we had data. And if you look at that data, actually, the interest rate cycles have come and gone. And when you are looking at periods where public equities are negative, that's where the private markets spread outperformance is the greatest. So it's harder, but we have performed. And actually that delta, by the way, now that the advertising ban was lifted in an earlier panel, I can say it's not 100 basis points, it's about 800 basis points. And we're happy to send these data to anybody in the room. So, so this is not entirely unprecedented. That's kind of the good news, part of my answer. The not so good news in many ways is what has changed is we probably will have it slower for longer. Slower in what sense? In private markets, which, by the way, I entirely agree with the title of the panel, because that's the answer already, right? The public markets, as managers, talked about the macro, and we talk about the future of investing. So in private markets, we are at the moment investing at a much lower pace than we were investing in 2021 and 22. And that's a good thing. The order of magnitude of that is come down from, if you had, and again, it's just keep thinking I'm referring to all of that data, not to my firm, not to any of these two firms, and we have money with both of them, but at the entire market. So if you were running at an investment pace of about 40% of all the capital that the industry had available to deploy, we're now running at not even 20. So it's less than half the pace. The liquidity that we're receiving, that clients and institutions here are receiving from portfolios is also severely down. And so that's a slower pace, but it's not zero. It's about, used to be about 23%, is now down to about 10, 15%. So slower for longer is not a major problem. The single biggest problem we had as an industry was the huge size of the vintage of 2007, right before the recession, as it turned out. And the single problem we will have to deal with in our portfolios is the size of the vintage 2021, which is also a record. So again, harder is okay. Slower for longer is okay too. And then I just make a comment about what may change in terms of the different strategies. If you think of the comments you've heard about private credit, which we agree with, is one of the best things to do, you just need to try to put in mind what is the current private markets portfolio looking like. And it's not a 60-40. It's actually more like a 90-10. So private markets, by and large, in big aggregate numbers, are an equity play. So when you hear someone say, put more in private credit, we don't come from a 60-40 position. It's not a massive portfolio bet. It's actually a relatively modest reallocation bet compared to what you're doing in public markets. So the room for growth in private credit needs to be looked at in that context. We think that one of the things that will dominate these discussions over the next 5+ years is these type of portfolio considerations, and they apply to the private markets as well. So we're very focused on them.
Fantastic, thank you. Hemant?
Thanks, Janet. And I also want to thank HKMA. It's been eye-opening to be here, to learn about all the opportunities, especially the Greater Bay Area, and just the company building that can be unleashed here with all the resources. So thanks for having me. So our roots as a firm are in venture capital. So a lot of our focus has always been about building new companies. And so our observations over the last 15 years with this sort of digital transformation of society that we're going through would suggest there are 3 big trends that we have to be thinking about in terms of value creation. And we're on the opposite end of the spectrum from Nate and CD&R, obviously. One of those trends has been going on for 15 years, right? It's been around mobile and cloud, and how do you build new experiences which allows you to create new brands. So we've built insurance companies, healthcare service companies, schools, banks with technology, with sort of a digital-first mindset. That trend, in our view, is going to continue to play on. There's a lot of industry, but there hasn't happened. So in the US, for example, healthcare is just at the beginning of adopting that and opening up to be a free market. There are other industries like defense and industrials and others where founders are also thinking about how do you build full-stack companies. The advantages that the new entrepreneurs have in that regard have been around what I call sort of the superpowers of big companies being made available to little companies. You get access to renting platforms for computation, for manufacturing, distribution, logistics. And with mobile, you get a distribution advantage where you can get early customers to get to enough scale that you become relevant. And that's sort of an unfair advantage for little companies. The second trend, which I suppose has been going on for a decade, but really hit the zeitgeist with ChatGPT last year, is around AI. And AI, first of all, what's really interesting is, every CEO in every company, in every industry, in every country is talking about AI at the same time. That has never happened. That did not happen with cloud. That did not happen with any innovation. So it really did hit the zeitgeist from a commercial perspective. And we think it's going to be transformative really fast. And this trend, to me, is more about giving superpowers of little companies to big companies. How do you actually go build transformative experiences if you're a big enterprise around customer support, contact centers? How do you do capital allocation and marketing? Think about every department you can redo. And it's the large companies that would benefit, and they would also have large challenges around workforce transformation, for example. Okay? And then the third challenge, and we talked a lot about it from a macro perspective, but I just want to sort of give some anecdotes on how it's hitting, is this is for the first time that there are a set of industries where politics trumps business. And we call that theme broadly global resilience, where whether it's defense or food or semiconductors or manufacturing, you're going to want to see companies built in your nation that take care of your people first and foremost. That has multiple implications. There's obviously structured inflation, and what does that really mean when you build those companies? But then there's also this whole idea that if you are a company trying to be global today, how are you going to build that business? You know, we had a holiday from history for the last 30 years with low interest rates, and you could be thinking about all globalization and always focusing on cost and efficiency. That doesn't happen anymore. So what are the models in which you can actually be a globally relevant new company? Again, I sort of think about the new companies that get built today, and be relevant, but do it in a way that you actually meet the national interests in those critical industries.
Thank you. Really interesting. So, probably going to build a little bit on what you just shared, Hemant, but relationship capital matters a lot in private equity deal making, from origination to sort of attracting top talent for the portfolio companies. So you talked about AI, and I guess I just wanted to ask you, so from a general catalyst perspective, you've got a number of investments across segments and countries. You also have a flood of new entrants into, you just talked about many new companies who all say that they are AI related or have embedded it a lot. So I guess from your perspective, how do you identify what's actually value accretive and proprietary technology versus just being part of the hype cycle or part of the marketing pitch from a technology perspective?
Yeah, it's been an interesting year, 18 months for us sort of thinking through that question. One of the questions I always ask companies that have been around for a couple of years is, when did you start calling yourself an AI company? Was that after ChatGPT, or were you really starting out as an AI company? The main things I would say around AI, you know, we did this exercise earlier this year to say which of our companies in software run the risk of being obsolesced by AI, meaning founders starting today or in the next couple of years, the companies they build will actually end up being more valuable than what we've been building for the last 5 years with these older stacks. And we did this whole exercise of making sure we integrate the language model technologies into them so they can take advantage of that innovation. In terms of how we think about the innovation that's coming out today, we probably saw about 1,000 companies this year in AI in the Valley, invested in about 6. We find it very hard to figure out how the language model layer is going to, on its own, capture value. That is a very difficult challenge because it's a big capital game. And if you think about a lot of these language model companies, they'll go spend a couple $1 billion, they build a model, and the very next step is go spend a couple $1 billion and build the next model. That's not how you recoup investment on your capital in your products. And there's this arms race there towards commoditization, which for us is very hard to figure out how to capture that value. We think on top of that, the idea of applying these capabilities around reading the entire internet, which is what these open language models are, and then applying it to different industries is quite interesting. So earlier this year, we started a company with this interesting team in the Valley where we partnered with 30 health systems. They contributed the data, which is private data, and we bet, let's go build a language model for healthcare that's safety first. So it's applied in a way that it's really designed for clinical decisions and making sure we don't make any mistakes. And it's designed in a way that we give the constitution of how to use it to those health systems so they can be responsible in bringing AI to that industry. So I think that layer is quite interesting. There are a lot of companies that got started, like last year, for example, that would use the APIs of these language models and build these thin products on top. Those companies, I think investors will lose a lot of money on because they obsolesce very quickly. There's just not enough value in those particular companies in terms of what they provide.
So a lot of dispersion. Thank you. Juan, Hamilton Lane reviews thousands of funds a year.
Yep.
and you have a very impressive database tracking managers over a long period of time. How are you incorporating technology in doing what you're doing in terms of data analytics and investment decisions? And then, I guess, are you seeing any pain points as you look at industry trends from your unique perspective that are coming in, that you're expecting in the coming years?
Yeah. I'm glad you picked me second, because now you cannot blame me for saying what General Catalyst just said, in the sense of every VC became an AI VC. Every company became AI. And we have the PPMs before AI and the PPMs after AI. And so it's not, so thank you for being honest and upfront. So that's one. But in terms of the nuts and bolts of your question, obviously, like any other CEO and any other company, we're trying to apply it and use it ourselves. We had a big data company in many respects as well, an investment manager in private markets, but data is essential. So AI is very strong in helping you handle large unstructured pools of data. And it has helped us screen, as we call it, hundreds of opportunities. We see about 1,500 funds per year. Our database is now at about 130,000 private companies, only private, and over sort of 50,000 funds through generations. So we feel much closer and much more in control of that data now that we put in place some of the tools. The considerations are also the ones that were mentioned, which is we don't want the Hamilton Lane data to be in the language model for everybody to be searchable. And so you ask what would Juan say about this? You just get the entire answer. So obviously being able to handle that in our own company, so with the Microsoft solution, for example, have your own chatbot, and reduce the work it takes you to own the data that you are supposed to own and have at your fingertips, has been a big value add from that. But I think a certain degree of skepticism as you make your decisions is important, and I think that's what came through. I also feel that us as private market investors have a lot of wood to chop, just generally speaking, on technology, not just AI. So AI will be a portion of the investments we make in innovation, but as companies, we have a lot of investment to do in technology that is not just AI. And I think a lot of that was covered earlier in the FinTech conference. So we're still an industry that relies on papers. Really. I mean, ask anybody operating our businesses to discuss quickly limited partnership agreement terms. They are on papers. Someone has to pull up a PDF. In our relationship with our customers, we still rely on nearly faxes, pieces of paper flying over, wet signatures. Hey, Juan, you use a blue ink pen to sign, not a black ink. You know what? This is a real situation. So there's a lot of tech that is non-AI that we risk actually skipping because we are all rushing to do AI. So I mean, this happens to us all the time. We have a company, we, Hamilton Lane, out of our balance sheet, have been investing in technology that applies to private markets for over the last decade. And we invested in one company which is called Tiffin. You can go check it out. As a management company. And nobody cared until we said that it was going to be an AI chatbot interacting with customers. That day, everybody took notice. And so, to some extent, that's great, but I think we need to still get our technology level one step up and our interaction with our customers to a better level before we're in a position to use AI.
I couldn't agree with you more. Nate, CD&R invests in companies, in numerous portfolio companies with the idea of building sort of long-term value. So how are you evaluating the risks and the value in these portfolio companies as we're thinking about disruptive technology, not just AI, but just disruptive technology and the trends we're seeing there?
Sure. We spend a lot of time on the topic. We have in our firm a group of former CTOs who help us in our due diligence, both from a commercial standpoint and assess both the risks and the opportunities that evolving technology presents to the companies, as well as to think about process improvement, cost reduction opportunities that technology applied to process flow can yield. We think about it for our own firm too. How do we make ourselves more efficient and take out some of the waste that is inherent in our industry? So it's a big topic for us. It's a big deal. Having said that, and at the risk of maybe being labeled a Luddite. I get asked a lot, is it going to fundamentally change our industry, much as it has data analytics, machine learning, and now AI has really changed the hedge fund industry? And I think no. You know, at least in the later stage private equity, so much of what we do, the way we do it, it's relationship-based, it's catalyzing transactions that create value for all involved. It's the operating capability that we bring to businesses after we invest. And so the idea that somehow that can be automated, even as AI continues to advance, I think we're a very, very long ways off from that. So I think it can help our business. I think it can drive value creation. I don't think it fundamentally disrupts our industry.
So just something else to watch. Thanks, Nate. The other big topic that we've been exploring over the conference has been ESG. So I just wanted to touch upon ESG. Managers and LPs alike are actively engaging, and given sort of the control nature of private equity and the deals that you do, many people believe that PE managers have a really important role to play. So I guess I probably just want to really explore how you're implementing ESG policies across the portfolio companies that you're working with. So I might stay with you, Nate. So from your perspective of sitting on multiple boards and investment committees, what role does ESG play as you build these great long-term businesses?
Sure. You know, we view, as stewards of businesses, we really view our role as making our businesses better in virtually every aspect. You know, that is what we're supposed to do during that 5 to 7 year holding period. And it means strategically we should reposition the businesses, we should position them for greater growth, we should drive productivity and returns on capital, and we should drive culture, and we should drive impact. And impact, you know, the elements of ESG are all part of that. Philosophically, we think that's the right thing to do as we think of ourselves as stewards of businesses with pretty significant reach. But I would say even if we didn't have that philosophical view, it is clearly the right thing to do from a value creation standpoint. We exit most of our businesses to either to the public markets or to strategic buyers. Those two sets of buyers care a lot about the sustainability of our businesses, sustainability in the sense of visibility into ongoing value creation, and increasingly sustainability in the sense of impact. And so even if we didn't have that philosophical view and we're just thinking about how do we create the most value in our businesses, the focus would be the same. And so I think this debate, you know, should ESG be a factor within the investment strategy? I think we're well past that, because it is now fundamental to a value creation process, and we've embedded it within our deal teams. You know, our deal teams are responsible for the investment strategy and for driving the business and for operational performance and financial performance and performance against the elements of ESG, because it does in fact drive value at exit.
Thank you. Juan, you also have a similar vantage point as you sort of...
He's getting a free pass on the corner.
I'm going to come to him in a minute, don't worry. Yeah. So you sit on various investment committees as well. So you work with many PE managers. So I'm curious to sort of, like, what's your viewpoint on this, and what trends are you seeing with the managers that you work with?
Yeah, I like the way Nate phrased it, which is it's over, you have to operate within an ESG compliant framework. If you interact with people like us or the clients we represent, you get sent an ESG questionnaire, and if you don't pass that, it's not going anywhere. So the framework has changed, and for us as companies, just as we apply to the investments we review. So then what's next? Let's talk about the problems. We have two fundamental problems, I think. Number one is data. Number two is kind of choice. Number one, data is we as causing the pain in the market, in the managers of gathering ESG-related data, can tell that there's no software solution out there. And so one of the things we went out and did, it's going to sound like an advertising on my investing for the management company, but we went out and co-founded a company called Novata, which begins with the premise, you could say it's a software company, but begins with the premise of no more templates, no more one set of key metrics for the whole industry. Don't try that. But if we had a software platform that was common to us, then the company that in Nate's portfolio that defines the KPIs from an ESG point of view that are relevant to that industry can use the same. Those companies can report to Nate, Nate reports to me. And the next company, the next sector that has different KPIs, different targets, then can use the same platform. That's a good thing. So it's not about a common set of standards and a rigid, oh, Juan said that that's the template. No, forget templates, forget what Juan said. It's about trying to find a common platform that is flexible on the definitions and KPIs and get more of that data. And that can lead us to benchmarking, that can lead us to more comparison, can lead us to sector definitions. And so we invested in that. We've done a couple of rounds, Microsoft and Ford Foundation and others. We're not the only investor, but we pitch it every time because we think it's something that the industry should consider. So that could go one way. We thought that was our responsibility to do on the data side of things. On the choices, what I mean by that is that if you travel the world, and I have the luxury of doing that, I have a global role based in Hong Kong, but I get around a fair amount. And it's very different, right? And it's been said before on the stage, so I won't belabor the point, but it goes from meaning something very specific in some parts of Europe to not being welcome at all in the conversation. Oops, did I say that? And in Texas, or all the range. So investors, and from an investor point of view, goes from a loose ESG framework compliance all the way to impact, which Nate mentioned. By the way, it was said earlier today that returns have been mixed. Our returns on impact are very good, so it's non-compromised. That's not the issue. So what I mean by choice is I think we need to make that choice. So far, clients don't agree, and that's probably the way it's going to stay forever. They will not agree on what level of impact they want to invest in. And nobody, by the way, has sold a portfolio based on ESG considerations. So we are all owners of assets pre-ESG revolution, and we are all unclear as to which level of impact we want to invest in. And that's okay too. We should not expect that to go away. Talk about the navigating complexity. So we think it's part of our solution to try to gather kind of KPI definition, template neutral data, as well as to provide investment choices clearly delineated for clients to make that choice.
So substance, flexibility, and value is what I'm hearing from you. Hemant, is ESG right for venture capital?
Yeah, so I think first thing is we are deep believers in the philosophy behind ESG. I think at our firm we believe that there's a false choice between impact and financial return, because the companies that really get to endure and be compounding investments are the ones that are actually positively impacting society. And so in that sense, we're big believers. We think ESG is tough in its evolution today because a lot of times the data is not accurate, standardization isn't there, and the focus is on short-term compliance versus really thinking about long-term, are we having that impact? I mean, as an example, no judgment on the company, but Tesla was considered not an ESG company, but it's literally an important company moving us towards electrification and transformation in the climate change world. Well, how is that not an ESG company on a long-term basis? So I think there's a lot of thinking that has to get done on what is ESG really, how to really accomplish this. Now, in our business, where you're actually starting companies, and if you agree for a moment that these companies will be a significant part of GDP worldwide in relatively short order, there's no data, and these companies don't have the ability to have an overhead to even be following these kinds of compliance regulations. We have been developing a framework that we call responsible innovation, which starts with the mindset of the founders, and are they thinking about things like sustainability, inclusive prosperity, integrity, and respect of human beings in the way they build these companies. And then we think about what are the mechanisms with which you actually implement that in terms of inputs into company building versus ESG, which is largely measuring outputs of a business. And there, business model choices, supply chain decisions, product decisions, what we call algorithmic canaries on how you measure in long-term unintended consequences of your product decisions. How do you do these kinds of things much more intentionally from a company building perspective? And so you kind of have to go from this inputs orientation in the early days to then, hopefully a refined version of ESG, and maybe your platform will help us get there, that can then be used by larger companies.
Thank you. Thanks so much, Hemant. I think we've got a couple more minutes. I've seen that some questions have come through, so I might read out a couple of those questions. So, question from the audience: do you see any good opportunities for blockchain-related investments? And related to that, will decentralized finance become the mainstream of financing models in the financial industry? So, not sure who wants to take that. Hemant? That's Nate?
Pretty clear. Sure.
Yeah.
So I think when we think about blockchain, there are two things. One is there is no decentralized finance in the long term if you don't interoperate with fiat and sovereign finance in the short term. And this is the big mistake that this ecosystem made with its hubris, which, there's been a lot of lost money and carnage in that industry. So that's sort of a design principle for us. In fact, in 2017, we internally said greed is the killer app in crypto, and we're just not going to go there. And that's really what everybody was innovating around. The second thing I would say is the mimicry around how to use blockchain to replicate what happened in Web 2 was, in hindsight, a mistake. Because you don't need to go build a new Pandora, which is decentralized when people like, or Spotify, which people like it enough as it is today, right? So going and trying to replicate these things where you will have suboptimal consumer experiences in the short term just because it's on blockchain. Like, why would consumers switch? And a lot of the innovation was done towards that area. In our view, I think finding examples where trust matters more than consumer experience, and therefore cloud actually did not successfully penetrate, are more interesting areas to think about using the blockchain technology. So as an example, we've been building a company around how do you put consumers' health data on chain so that it can be shared in a democratized way, and the consumers have control in the US. I mean, today, if somebody has cancer, their family is going bankrupt because they don't know what to do in terms of taking care of themselves, while some middleman company is enrolling that person in a clinical trial and making money on it. Well, it's their asset, and how do we actually move that entire industry onto chain so the consumers directly benefit for their data? So looking for examples like that, where the existing models didn't really crack it. Carbon credits is another one. The agencies that determine the efficacy of the carbon credits, we talked about this yesterday, are quite inaccurate, and there's not sort of a standardization, and there's not a lot of trust in how those projects really generate credits. Well, how about we put that on chain and actually create a new process? So I think those kinds of examples is where I want to see entrepreneurs building and demonstrating value in the short term.
Thank you.
Can I add just a quick one?
Yeah, of course.
And the other industry ripe for that is private equity. So I think actually blockchain has a lot of smart contracts, and having our relationship on chain is a game changer for private markets. In that respect, we could leapfrog a lot of the steps that were taken by public markets, but blockchain as technology, not crypto, but it's ideally designed to bring ourselves away from the operational friction that we currently have, to much more of a liquid or much better operational environment in private markets, which has a lot of consequences in terms of the investability of some of the assets we handle, and getting ourselves from T plus 90 days, which is where we are now, to T plus 2 or closer to, I think. And a lot of that it has to do with tokenization, and there's been great initiatives, and just generally speaking, we're bringing more the ID registers to the chain within private markets.
That's probably a good segue for me. In terms of wrapping up, I'd love to ask the three of you opportunities that each of you are excited about, and then also what are the prerequisites for those opportunities to play out? I'm going to start with Nate from a buyout perspective.
Sure. Maybe it circles back to where we started. These are uncertain times, and I think people are feeling the potential disruption. That causes for us, founders, corporations, to rethink their strategy, their portfolio. And so the opportunity to bring capital, to bring solutions to people in this environment that creates value for them as sellers really is the thing that allows us to both create value for them and then create interesting transactions for ourselves. And so these more disrupted, more in certain environments are actually really, really interesting for our particular business model.
Thanks. Juan, from a global solutions perspective.
Well, I'm sitting on the same chair Howard Marks was sitting a minute ago. I'm not going to say credit. But I will say one thing that was said earlier. I'll overemphasize secondaries. So within private markets, buying from other LPs or buying from funds, providing liquidity to GPs, is shockingly small, and as in less than 2%. So just think about that of any other industry where the turnover of existing inventory is just 2%. It has to grow. The selling interest annually is about $250 billion, of which only about 125 actually closes. How do you like to be a buyer in that industry, right? And for all the talk about 10% for senior credit, 11%, 12%, no portfolio of secondaries has ever lost money at a fund level. So I like my downside on that, and we are writing 15 plus with upside to it. So it may sound like a minority, it may sound like connected to distress environments, but secondaries, go big in secondaries in this environment is one of the easiest things to do in our mind.
Thanks, Juan. Hemant?
So our investors give us money to invest in the future, live in the future. And I think when you think about the era today from an innovation standpoint, AI, AR, biology, blockchain, all these technologies are about to inflect. Some are further ahead, some aren't, but it's all in the next 5 years. These things are going to inflect, and there's a lot of interesting companies that are going to get built. So that's exciting. The idea I'm walking away wanting to think more about and be inspired about after this last couple of days is more about what is the model for borderless innovation. So going back to my comment earlier about the Greater Bay Area, thinking about how we're going to take on problems that truly are global, climate change and pandemic resilience, for example. We need a new model where innovation actually can lead to uplifting countries all over the world at the same time versus being stuck in this increasingly bipolar world. And can we come up with a way to innovate with that mindset across the globe? I think that'd be really exciting and could lead to some amazing companies who can figure that out. So I encourage all of you to think about that.
I love that point to end on. So I just want to say thank you to the audience. Thank you to these three gentlemen. It was just fascinating conversation, really unique viewpoints as well. And while these trends are here to stay, I think client capital is in good hands. So thank you very much.
And thank you, Janet. Marvelous job. If you wouldn't mind taking a photo, ladies and gentlemen, we are going to be taking a very short break. We're going to repeat yesterday's trick. So if you go outside, grab some coffee, refreshments, breaks, please come back in. We're going to start again at 11:20 with the risk takers. So there's going to be a lot of excitement still happening here. At the end of the day, we will have coffee and refreshments out for more than an hour. So you can do lots of networking then. So, don't feel constrained by this break. You can go out, do your thing, but be back in your chairs at 11:20 and ready for action. Thank you. And thank you very much. We are back in action with our conversations with global investors as part of the Global Financial Leaders Investment Summit right here in Hong Kong. Thank you to everybody for joining us today, and thank you to everybody watching around the world. Volatility is what we sign up for when we get into this game, and frankly, without it, we wouldn't be making any money. But there can be too much of a good thing. But when the VIX is up and up and up, our panelists rise to the challenge. They're all about seeking and capturing alpha. And they're going to come up here and discuss that, and also how they think about things that seem like more inherently risky alphas, like for example, digital assets. And we've got a great panel to do that with. So they're going to come up led by their moderator, Mr. Albert Goh, who is the Chief Investment Officer at the Hong Kong Monetary Authority. Here he comes, and he's bringing the panel with him. He's got Chris Gradle. Chris Gradle is the co-founder and CEO at PAG. We also welcome Sir Paul Marshall. Sir Paul is the co-founder and CIO at Marshall Wace. And rounding out this panel, we welcome Peng Cao, who is the CEO at Citadel Securities, all the way from Miami. Ladies and gentlemen, this is your panel. Let's talk risky assets. Thank you. Albert.
Thank you very much. Welcome to our panel risk takers. And today we have 3 very successful risk takers joining us on stage. I'll do a very brief introduction. Zhao Peng, Citadel Securities, CEO, one of the world's leading market makers who combine deep trading acumen with cutting-edge technology to deliver critical liquidity to the global markets. I got this from your website. Sir Paul Marshall, founder and chairman of Marshall Wace, a leading hedge fund found for pioneering alpha capture strategies by integrating systematic and fundamental processes in portfolio management. I got this from your team. And Chris Gradle, the CEO and founder of PAG, whose firm is the largest fully diversified alternative investment manager in Hong Kong. I got that myself. So let's kick off with you, Peng. So Peng, you have completely and successfully disrupted the traditional market-making industry. Don't worry, we're all buy-side here on the panel, so this is a safe environment. I don't know about outside, but we're safe here. How did a newcomer like Citadel Securities become one of the largest market makers in the world? What is your secret sauce?
Thank you, Albert. First of all, well, thank you for having me, and thank you for that very nice introduction. I was about to say that was such good writing, and I found out my team wrote it. Well, first of all, we prefer the term innovator. Yeah, I mean, as a market maker in particular, you really don't want to be disrupting anything. But you're right, and it is right in the write-up that you gave as my introduction. We took a technology and analytics first approach to solving market problems. And that was our core insight from day one. And we combined that with a deep commitment to both understanding and solving real market problems. Right? So oftentimes there's this misconception that we build these fancy black boxes, and we do have them. But it's just as important what we put into the boxes. We have, in fact, as many financial professionals in trading and research as we have in quantitative research, actually more. So deep product insight, deep market insight, deep understanding of what our counterparties are looking for, what are the best ways for us to solve their challenges, their problems, and add value for them. And all of that combined with a commitment have had since day one to world-class talent. And that's been the recipe for our success. that we have been able to apply over and over again. Now we're in over 50 different countries, over 100 different markets. We have offices all over the world. We trade anywhere from the more boring US stocks, that was touched on multiple times at your conference today, and then all the way out to developing countries here in Asia, in Europe, and everywhere else. And we just launched our credit business this year as well. It's really that philosophy approach that, that we've been taking to all over the world in the world of finance.
Thank you very much. Over to Paul. Please tell us about the amazing journey of Marshall Wace. What made you develop your famous alpha capture system and your sophisticated trading system?
So we started in 1997 as a small European long-short fundamental firm. About 4 years in, we developed alpha capture. And to be completely honest, it started almost as an accident. So my partner, Ian Wace, who was from the sell side, he said, listen, we got all these brokers. We're paying them lots of commission. How do we work out whether they're actually worth the commission we're paying them? And historically, with the way you allocated commission was just a little bit of this, and it was very subjective. So we said, well, let's measure them. And to measure them, the web had just really come into to play. And so we had a very brilliant young trainee who developed, it was called Anthony Clake, who developed a web-based system where we effectively reverse engineered our relationship with the street. So we asked all of the people who covered us to start running virtual portfolios for us. And to my utter surprise, there was a lot of alpha. As a result of that, about a year later, we said, well, wait a minute, we have this incredible source of alpha. Why don't we turn this into a portfolio for ourselves? And that led to the development of optimization, portfolio optimization, and then quantitative trading. And then later on, we took all of those learnings and those systematic skills to our fundamental business to deliver the same types of optimization and trading skills and applications across our business. And now the business is roughly equally divided between fundamental and systematic strategies. And we've brought in all kinds of data applications into all parts of the business.
Thank you very much. Chris, you were born in Northern Ireland, but you spent your professional life mostly in Hong Kong and China, building PAG into a $55 billion asset manager. Please share with us your journey.
Yeah, so I guess it's a long way from Northern Ireland, but I was lucky post-university to sort of have an opportunity. Well, I was sent to China by sort of a large private investment firm and started, this was 1995. And, you know, I just found it just an incredibly exciting place to be. And, you know, was fortunate enough to be able to, you know, lead several investments in China in the 90s. And, you know, when I turned 30 and had a big sort of midlife crisis and sort of felt if I don't start my own business now, I'm going to be too old. So when I started my own business, you know, I think I always felt that I wanted it to be a regional business rather than a pure China business. And I felt Hong Kong was the place to do that. So we started in public markets as a hedge fund and then evolved over time to private debt. And then actually 2008, which was, you know, obviously tremendously stressful time, you know, we managed to, you know, make money, survive that, and that really opened up just a lot of opportunities. And we, you know, surviving that, having invested in an infrastructure, then that allowed us, you know, we acquired a real estate firm,
We were able to attract some great talent, and really then we became the firm we are today, where we have private equity, real estate, private debt, and public markets. So we started as a hedge fund, and it's still an important part of our business, but we're very diversified now, both on asset class and across the region. And I think it's good for us as a firm. It makes us more stable, but also we can flexibly look at opportunities and go where opportunities are, and we're not looking at only one opportunity.
Thank you very much. Okay, let us shift gears to Hong Kong. Peng, thank you very much for building up your amazing franchise in Hong Kong. Tell us more about your Hong Kong connection and what prompted Citadel Securities to double down in Hong Kong and China when others hesitate.
Sure. So I was born and raised in Beijing, but my father worked in Hong Kong throughout the 90s. And I spent my winter break almost every year in Hong Kong growing up. So not only have a personal affinity to living in Hong Kong, much of the reason why I think I ended up in finance was because this nerdy boy who was into mathematics and programming, who also got this exposure, very early exposure, especially for other kids who grew up like me, to financial markets. So everywhere, I remember, every channel I was flipping through when I was in Hong Kong, there's always this rolling screen of a banner of red and green and charts, and if you're into numbers, you get really fascinated by that. So part of the reason why I am the CEO of the largest market maker in the world has a lot to do with having the time I've spent here in Hong Kong. Now, that is not the reason why we have grown our team here in Hong Kong. It didn't hurt. But we've always seen Asia and the greater China region in particular being has been one of the largest driver of global growth and innovation, and we continue to believe that it will play a tremendous part on a go-forward basis. So seeing the opportunity in markets, seeing the opportunity in talent, make it that it baffles us when people do not invest like what we have done. I mean, in fact, during the years of COVID, despite the challenges, we have doubled our headcount in the APAC region. And Hong Kong in particular has advantage. I tell my team that, look, we're in Japan for Japan, we're in Korea for Korea, we're in India for India. But we're in Hong Kong to have a base and a hub for all of Asia and even globally from a talent perspective. And just yesterday, I caught up with a friend who I got to know at University of Chicago and who moved to Hong Kong to help run one of the programs at one of the top universities here in Hong Kong. And over the last few years, they built a new program. And last year alone, they had 2,500 new students, almost brand new program. That's the size of a college in the United States. I think only here in Hong Kong, a story like that can happen. And that's just a small example from a talent perspective alone.
Thank you very much. Paul? You set up your Hong Kong office in 2006 and built quantitative strategies to extract alpha from local markets. Now, that's way before anybody else did. What drew you to Hong Kong?
So Hong Kong was our chosen hub for Asia. I think a lot of people in those days would have chosen Hong Kong as the hub. And I was very pleased to hear yesterday people talking about common law and the rule of law, which is it's a really important factor. Common law, the common law is by far the best type of law for finance because it allows principles-based approach to lawmaking. And so it's great to hear the emphasis, and that's no small thing. The talent here is very strong. And then, of course, 2013-14, the opening of Shanghai Connections and Connect was a huge event because Hong Kong is clearly the gateway to China, and China is most years the best alpha market in the world for us. And we may make double-digit alpha unlevered from China. This year's been harder, but most years it is a fantastic alpha market. It's a very liquid market. It's the second most liquid market in the world behind the US. The liquidity is 4 times Japan, more than 4 times European markets. So it's a really great and vital market for us. And we now have Asian offices also in Singapore and in Shanghai, but Hong Kong remains our largest office, and you know, there's lots to come in terms of further deregulation and opportunity.
No, that's a very good point. I'm a trained barrister, and I think common law in Hong Kong is so understated and such a key point. Thank you for raising that. Chris, you were a competitive rower at Oxford. Now, I've done enough rowing myself to know that rowing is a cruel sport. In rowing, everyone will hit that massive wall of pain, but only those with a good mental strength to push through that wall of pain will win. So is operating and investing in Asia a bit like rowing these days?
I don't know which wall of pain, hopefully not one that's coming. But no, look, obviously, I think all markets have challenges and opportunities. And, you know, I'm very glad that we are diversified across the region and markets, because definitely opportunities come and go, and markets provide more alpha, less alpha, more opportunities and less opportunities. You know, I think we, similar to Peng, you know, we do a lot of, part of our philosophy is to be local in the markets. And I think that's very important. So we have local teams in all the countries we're active, but Hong Kong is our main office as well. And I think on public markets, on support functions, there's the deepest pool of talent in Hong Kong, which has helped us tremendously in growing the business. And, you know, I think geopolitics is, of course, a topic that many people have talked about, and obviously there was some movement perhaps out of Hong Kong, but you know, well, I'm biased. I think Hong Kong's the best city in the world. I love living here, but you know, we recently hired a new CTO who was CTO of one of the big global firms, moved from New York to Hong Kong. We've had no problem actually attracting talent here, and there's a good base of local talent. And you know, maybe Singapore's been a victim of its own success. You know, we now face bottlenecks there, which we don't face here. So I think for us, being in Hong Kong is a great place. It's the most convenient location to deal with the region. Again, the legal system is great, and it's very encouraging that last year, when President Xi came, he actually stated that the one country, two systems would extend beyond the 2049. And I think many people focus too much on the one country and forget the two systems. I think the two systems is very important. So. Yeah, Hong Kong for us has actually been a very great, flexible place to sort of oversee our activities around the region.
Thank you very much. I think Paul also has something to say on talent and attracting talent in Asia.
Well, just to say, ahead of this panel, I looked at the Marshall Wace demographic breakdown. In fact, 24% of our workforce worldwide are ethnic Chinese. So we employ about 550 people. And by no means all of those are in Asia. We have a lot of ethnic Chinese in the US and the UK. But there's also something which is very intriguing to me, is that Chinese women are extremely good portfolio managers and analysts. And we have, the sample size is not necessarily big enough to do a kind of proper academic study, but we have an incredibly high hit rate of very good and successful Chinese women at Marshall Wace. So we'll see.
We will. So Peng, you're not escaping this one. So again, on the talent war, Citadel is clearly fighting a very unfair war. You recently took your entire firm to Disneyland in Tokyo. By the way, we do have a Disneyland in Hong Kong. So how's the talent war working out for you?
Well, I mean, that's a good example of deep commitment to our talent and employees. Actually, we did it twice. We brought all of our employees and partners and their family to Disney Orlando end of last year, but from North America and Europe, right? And but for our families here in Asia, taking your kids out of school for 3 days is unthinkable. So therefore, we brought ourselves here to Asia and hosted all of them in Disney Tokyo. And the reason that it's not in Hong Kong is because most of them already live in Hong Kong. So that wouldn't be quite a getaway. That's more of just a regular weekend. But yeah, no, I think deep commitment to talent means not just, you can't just have that as lip service, right? That means when it comes times to make difficult decisions, you put talent first, right? From a willingness to delegate our most important decisions to the lowest level within the organization that's appropriate, to, you know, we're one of the first firms to bring all the employee back into the office. You know, look, it's a lot easier for ourselves as senior leaders to operate from our homes, but if we don't bring everyone into the office, if we didn't bring everyone back into the office, then we're depriving the newer members of the team from the fulsome growing and training experience that they would have deserved. And that's also part of our talent strategy, where we don't try to be everything to every person. We're very true and firm to how we want to operate. And we're very transparent about it as well. And we don't have to be the firm for everybody, but we want to make sure that if they are signing up to our culture of meritocracy, to winning, to integrity, they're going to get the best chance to build a successful career anywhere in the world of finance. I'm sure every panelist is going to say the same. This past year, we have had not only our largest class of campus hires that we've ever had, but it's also been the most selective. For every new member of our team, there were more than 200 applicants. They had to each beat out 199 other applicants to get a job here. And that trend is continuing because we already have early data for this year. Yeah.
Okay, Paul?
Well, I wanted to say something slightly more serious from my end about the talent war, because clearly that phrase is now circulating, and it's describing something that's going on, which is that led by the platform hedge funds, paying incredible amounts of money to target people. Now, on some level, that is justified in the sense that I do believe that the Pareto principle applies in fund management as much as in other parts of life. And everybody wants that Cristiano Ronaldo on their team, but there aren't very many Cristiano Ronaldos. And what's happening is everybody's getting paid the same as Cristiano Ronaldo. And it's leading to a commodification of human talent, so that people are getting paid very big, silly sign-ons, and then they last 2 or 3 years, and then they and then they get fired, then they go somewhere else. And that's not the right way to build great businesses or even to build a great industry for our clients. And so what we're trying to do is build IP in people. So when we hire people, we put everything around them to support them, to be the best of themselves, so that they stay with us and build sustainable careers, which will end up for them being a much better choice than going into this kind of battery hen farming merry-go-round, which is what's happening to some degree in the platform world.
I mean, just to sort of, I mean, we've had from we have a platform as well. And, you know, we've seen some staff bid away for literally 8-figure numbers on sign-ons, which is absolutely insanity. And we say, you better take it, you know, because, and given again, the whole platform model is very much, you know, it works because, yeah, you cut losses quickly, and often the lifespan of portfolio manager can be quite short in some of these platforms, so which makes it even more insane to spend these values, as Paul said. You know, I think for us it's, you know, we really need to, what we're trying to do is create an environment where the PM can be successful for the long term and build a career and around that. And that, you know, after people have been spit out by some of these firms for a while, actually, and you can see it in Japan in particular, you know, the industry is sort of like, well, some of these firms are career killers, you know, and people actually look for a place which is more supportive. And so we've had a very positive sort of experience. I think this is a temporary phase. It's a very bad phase. It's good for certain people, I suppose, for some PMs, but it's not good for the client. It's not good for the industry.
Thank you for saying that. We don't like paying fees. Thank you. Okay, let's switch gears a bit, given the time. As I did my research on the 3 panelists here, I must say I'm very inspired, in particular to all of you, because you have all given significant personal wealth away to charity. And oh, by the way, we have colleagues on standby to help you set up family offices in Hong Kong on your way out, so don't leave too quickly. But I'll start with Chris. So Chris, you set up the Institute of Charity at Oxford. Can you tell us a bit more about that?
Well, you know, I think the whole sort of world of charity, you know, it's actually amazing how little research has been done in terms of the effectiveness of charities, in terms of their giving, in terms of what organization structures work better and less. And, you know, the university had an idea, and I thought it was a fantastic idea to sort of really invest in this. And again, I didn't realize how big the gap was. At the opening of it, we had the head of many global charities came. We had the UK government head of charities. We had a lot of academics from around the world came, really excited about this and how important they felt it was that there was more research done in this area. And so, yeah, I was excited, but when I saw the enthusiasm, I actually became a lot more excited. And so hopefully we'll see some interesting sort of research come out of that.
Okay. Paul also leads in this area. I think you famously set up the LSE Marshall Institute for Philanthropy and got knighted for it, I believe.
Yeah, kind of.
Please tell us more.
No, I didn't realize Chris had done that at Oxford. So the interesting thing is that, I mean, we set this thing up at LSE about, I guess, 7 or 8 years ago. I don't know when you're...
just this year.
So we took the donation. We went around all the UK universities and offered them a donation to set up an institute. And at Oxford, they said, oh, I don't think this is worthy of academic study. So So,
because you're from Oxford too.
Yeah, and I was from Oxford. That was my bias to go there, but they weren't interested. So they've obviously had a Damascene conversion along the way. You've obviously converted them. And, but so we did this at the LSE, and then we set up what's called the 100X accelerator. So we're trying to replicate what the Y Combinator did for the private world for social enterprise. And I agree with Chris that essentially, actually, the charitable and philanthropic world is massively worthy of study. There are different types of metrics you need to apply. You need to study different types of the way incentives work, the way altruism works. All of these things are not properly analyzed and understood. And so, there is huge potential both for what you're doing and what we're doing. We should join forces.
Yeah, absolutely. All right, Peng, your turn. Thank you very much for being a co-founder of the Asian American Foundation. I think you are pretty much paying all the bills for that. Can you share with us how this foundation is supporting the Asian community in America?
Yes, thank you for giving us the platform to talk about very important works, and truly inspired by the work that my co-panelists have done as well. I'd love to catch up more about that. So I think it was right around the time of pre-pandemic. I was noticing, unfortunately, this trend of rising discrimination that too often translated into acts of physical violence against the most vulnerable members of the Asian American community. It turns out there were a number of like-minded people among my friends as well. So I got together with my co-founders, with Jerry Yang, Joe Tsai, Joe Bei, and Li Lu. We got on to a discussion with Jonathan Greenblatt, who is the CEO of Anti-Defamation League. That's the leading Jewish anti-hate organization in America, and start discussing what we ought to do. And that kicked off a real working group together to figure out what's the right strategy. And one of the things we discovered was also that even though Asian Americans are the fastest growing population within America, it counts for more than 5% of the total population, but only 0.2% of the philanthropic dollars in America actually went to Asian American community. So instead of learning how to bake or adopting a dog or have a new baby, we got together over COVID and funded the Asian American Foundation, which ended up being the largest philanthropic launch for Asian Americans. So starting from launch within 3 weeks, we raised more than $1 billion for the community. And since then, we find that not only there's the critical mission of to protect and create a sense of belonging, there's also so much opportunity to celebrate the contributions that the Asian American community have made in the country of America. I can go on and talk about this for hours, but I'm going to use this as an opportunity to give us a shout out. So if you want to learn more, go to www.taaf.org and learn more about the work the team has been doing since we've started it.
Okay. So we actually have an entire section on innovative, disruptive technology and all that, but I think we're running out of time. So I'll just jump straight to just one, and I'll direct it at Paul. So Paul, in 2020, you wrote this book, a bit lighter than Harry Potter, but it is titled 10.5 Lessons from Experience. It's your perspectives on fund management. And in there, you basically wrote about cognitive bias, the use of data and systematic strategies by fund managers. And if your editor is to call you today to add a chapter on AI and ChatGPT and whatnot, how would you write it?
I think, and it was interesting to see how much it's come up in the last 2 days. I think generative AI is very overhyped in relation to fund management. It's overhyped because of ChatGPT obviously led to kind of retail awareness, and as somebody said earlier, every CEO needs to know how they're deploying AI in the firm. But for a firm like us, we've been doing machine learning and natural language processing for upwards of a decade, and that's massively important. So that, in that sense, AI, that kind of AI is massively important to our business. Generative AI is essentially primarily a search, a much more powerful search engine. Somebody called it a stochastic parrot, which I thought was an amazing phrase. But it has an incredible ability to search the web for data and to summarize very, very quickly. That doesn't necessarily lead to changes in alpha generation. It is, for us, primarily a productivity tool. So if you look at the use cases in Marshall Wace of a generative AI day, they are primarily twofold. One is helping our coders, so the co-pilot function, and the second is summarizing text for our analysts. So it just massively enhances productivity, but doesn't necessarily lead to changes in the ultimate alpha. It just makes it less expensive, hopefully, to do it. It should lead to productivity transformation in every part of the business, and even the lawyers. So the ultimate profession, which has never been disrupted, may finally be disrupted, which would be wonderful. So if I was doing another chat, I used a quote from Gary Kasparov when he lost to Deep Blue. He said, the machine beats the man, but man plus machine beats the machine. And that would still stand. So it will massively, and is massively transforming, AI generally is massively transforming the business, but you're going to still need humans to be the people who generate the hypotheses and point the machines in the right direction.
Peng, you're a leader in that field. Any comments or responses to that?
Yeah, I mean, I think our view on the field is amazingly similar to Paul, so I'm not going to repeat those points. I'll just simply add to it. I think one aspect of all of this is some of the tasks that firms like ourselves have been able to do in the past that define part of our success are easier to do, given the more broader availability and easier availability of some of these tools that make those things easier to do for other firms. And I think that's as a phenomena, that's certainly true for the financial services sector, but other industries as well. I do think companies and institutions will get paid less and less for simply competently carry out some repetitive tasks. And it become more and more important to have a clear mind on what are our unique insights, what are the areas we have true excellence, and what are the unique value propositions that we bring to the marketplace. And that's always been important, but this moment highlights that that's going to be more important than ever on a go-forward basis.
Thank you very much. We only have a few minutes left, so I'm just going to dive into something a bit more fun. We're going to enter into a brief session on quick-fire questions. Now, the rules are very simple. Do not think on your feet. Okay? Shoot from your hip. There are no wrong answers. Okay? And your compliance officer is off duty. All right? So the first question is very simple. You are sailing solo across the Pacific, and you're given two choices, two things to bring as a companion: ChatGPT or a dog. Chris?
ChatGPT. I'm more of a cat person.
Paul?
I'm allergic to dogs.
Definitely a dog. I'd take all three dogs, actually. Yeah.
Somebody told me that in an emergency, you cannot eat ChatGPT. It's a bit sick, all right? It's sick, all right? Let's take it off. Okay, the next question is in honor of Byron Nguyen. For those of you who know him, he published an annual list of top 10 surprises for 38 years, and sadly, he passed 10 days ago. So this is in honor of him. So the question is, what will be the biggest surprise of 2024? Just shout it out when you're ready. Paul, maybe?
There won't be a recession, but it's not what I believe. But I think because the way the Fed's playing around with financial conditions and they're becoming so cute, they're certainly going to try and manage it in a way we haven't seen before. I still think it's at least 50% chance there is a recession, but I think, and the consensus yesterday was that there would be a recession, so that's why it's a surprise.
Sadly, I don't think an end in the wars in Ukraine and maybe Middle East, I don't think, sadly, that those will be surprises next year. I think there's some big elections next year which could throw up some surprises. Let's see, I worry about that.
Well, yeah, actually along those lines, I think the rise of a real alternative to the two current frontrunners in U.S. presidential election.
Yeah, so that's in line with mine. I believe that in all the elections in 2024, all the successful candidates will be moderates. It's wishful thinking, I know, but surprise. Okay, quickly, moving on. Thanksgiving. In the spirit of Thanksgiving, what are you most thankful for this year? Quick fire. Peng?
I'm thankful for being reunited to my friends and family and colleagues and new friends around the world, finally.
Paul?
I'm thankful for my family.
Oh, good. Chris?
Yeah, the end of COVID we have to be thankful for that, yeah.
Good one. For me, cash is yielding 5.5%. I've got a place to hide. I'm very thankful for that. Yeah. Okay, something or someone that inspired you recently?
Actually, being here in Hong Kong, seeing that people from all over the world, all different cultures, living, working together towards a common goal of prosperity, that's very inspiring. We don't talk about that and see that enough in the world today.
Thank you. Paul?
I'm slightly talking my book because I partially funded it, but the conference last week in London called the Alliance for Responsible Citizenship, which was a group of leaders from all walks of life, basically trying to remind ourselves and everybody else that Western civilization actually has some things which are quite good about it, and which were the foundation of its prosperity. And we're in danger of forgetting them and losing them, and they need to be revived.
Okay, thank you. Chris?
I mean, I think, the Chinese market has been pretty difficult, and obviously I think confidence is still fairly low. But, I always say, when you're doubting China, go and visit China. And, just in Hangzhou last week, and I was just blown away by the amount of EVs on the road. Actually, the traffic noise, weirdly, there's loads of traffic, but it's quieter. It's quite weird, actually. And the amount of innovation, and actually that economy is a lot more resilient, I think, than a lot of people think. I think that I found it quite inspiring to be there.
On that very positive note, we'll end the panel. Thank you so much. All three of you have been great. Thank you very much, everyone. Thank you.
And thank you, Albert. Great job. Gentlemen, if I could get you in center stage for a picture, please. Of course, we do want to capture the moment. And I'm glad to hear our Chief Investment Officer for the HKMA likes his cash is king. He's got his 5% a place to hide. Bodes well for Hong Kong's monetary stability. Fantastic. And Peng Xiao's kind words about Hong Kong, my home of 27 years. Happy to hear it. And thank you very much, gentlemen. Well done. Albert, great job. You might want to take your literature with you. You don't want to leave those behind. Have you got them signed yet? Now's your chance to get a signature. Fantastic. Thank you. Hong Kong sits right in the heart of Asia, smack dab in the middle of all the action that happens here, and private equity investors have to think about how they can have the biggest impact in this massive region. Our next panel is going to be looking at private equity market strategies and what that means for how they invest and what it means for the execution of deal making in Asia. We've got a great panel coming up. They are going to be led now by Ganesh Savarnanthan. Ganesh is the managing partner, head of Asia and the Middle East at TPG. He's leading a great group up here. Are they ready for action? Gentlemen, on your feet, and let's see you move. As they come up, we'd like to welcome Chip Kay, who is the CEO at Warburg Pincus. We have Zhang Lei, who is the founder and chairman at Hill House. And we have established that the other Zhang on the panel, Zhang Yicheng, is maybe his brother on this panel, but we're not raised in the same household by the same parents. But we would like to welcome Zhang Yicheng, who is the chairman and CEO, of course, of TrueStar Capital. So ladies and gentlemen, this is your panel, and Ganesh, take it away.
Thank you, Andrew. Firstly, I got to thank the HKMA for giving me so much power to be able to moderate all these people. It's a wonderful position to be in. But no thanks to you for making me come up to moderate after Albert go. First piece of news, I have not done research in all three of you to bring your books, so I don't know what you've written. I also haven't done the research to figure out how much you've given away. But we will try and see what else we might be able to do in this period. So just to introduce everyone that we have today, Chip Kay, he actually started Warburg Pincus business the same year my firm was founded in 1994. So 30 years ago in Hong Kong, now runs the firm in New York, has named a successor who actually came from Asia. So the Asia feel at the Warburg Pincus headquarters will continue. We hope to be able to drink Jeff Pearlman's wine, though, in Singapore and make sure that he doesn't take it with him to New York. But that's great to introduce Chip. Lei Zhang started his firm with $20 million from Yale 20 years ago. About 20 years ago, and it's now 80 billion assets under management. So if there's anyone that needs inspiration on the Asia miracle, Lei walks that. And Yicheng moved from New York to go set up City Capital's business, and now runs it, chairs McDonald's franchise in China, which is one of the great private equity deals of all. Also is chairman of GNC and has an extensive portfolio in China. So we're gonna really start with Chip. From the '94 to now, really how's that experience been, and what did Asia do for your own sort of career running a firm from a global lens?
Well, thanks, Don. First, it's always a great pleasure to be back in Hong Kong and to thank HKMA for the opportunity to do so. As I lived here for a good chunk of the 1990s, and two of my children were born here, so the place always has had a real fondness for me, and a real treat as well to obviously be able to be a part of the panel with probably one of the first people I ever met when I got here, which was Yicheng, as well as one of the people I've come to know more recently, but probably respect most in Lei. So I take that as the greater source of pride than being on the last panel of the day. I was actually first in China in 1982, actually before I went to college. And I've witnessed sort of the transformation of China from a place that's almost, I still have memories in my mind of what it looked like then, but from a place that was, I don't know, a couple $100 billion economy and a couple $100 per capita income to one that is now $18 trillion. And the physical transformation of it and the scale of it, to me, is always what has been most remarkable. And the chance to sort of witness and see what might be one of the greater economic transformations in history is sort of one of the things it's been one of the sort of more interesting dimensions of my life. Obviously, over the last handful of years, what propelled that economic transformation, elements of the model and the elements of that rapid, pace of 10% growth for 40 years, has created some set of turbulence. And there's dimensions of uncertainty, and there's sort of an inflection point. They're all trying to kind of grasp what comes next in all of this. And I think one of the things I've benefited from by being at Warburg for almost 40 years, and the firm itself going back to really being the oldest private equity firm in the world, is to learn that, great fortunes and great ideas come at the most complicated moments. There's the famous John Maynard Keynes quote that, worldly wisdom teaches it's better to fail conventionally than succeed unconventionally. And I think at moments like this, we sort of all need to kind of recognize that the scale of what's taken place today always brings with it a set of challenges that follow. And those that persevere and retool and repurpose and rethink and think about what the environment looks like ahead, there will be opportunity for. And I think for investors broadly around the world, for all the dimensions of uncertainty and complexity that have been talked about over these last couple days, it's a part of the world that, it's a third of global GDP. It's twice that of global growth. And for many investors, it probably maybe even barely represents a double-digit percentage of their asset allocation. And so I think for those that are here, there will be a place for diversified investors that are trying to create consistency of return for whomever their clients or fiduciaries or constituents will be. And obviously I live in the US. The US has benefited enormously as a result of sort of the globalization wave and the like. And for most investors, it's not a negative commentary vis-a-vis the US, but for most investors, that might represent 60 or 70% of people's assets relative to a quarter GDP. So I think Asia represents a place that's still rather underinvested, both globally and in the context of what are rising pools of domestic savings. So I think the story is yet to be told as to sort of how the region will play out. And obviously, Hong Kong will be an interesting perch from which to watch it all happen.
Lei, the 20 million to 80 billion journey, you would have seen lots of different phases. How do you feel about the market environment now? What's changed? What's different? Other than hoping that you buy all our portfolio companies, what else are you focusing on?
That's wonderful. Thank you. I was thinking, just Chip said earlier that, world wisdom saying that fail conventionally than succeed unconventionally. If you could put it in other words, actually, the best companies are built in the worst possible challenging times than the good times, actually. And you really think about the Asia and had a very good run, and it's in the period of time of investing was riding tight, lifting all boats. Right now, there's some economic challenges and growth and slowing down here and there, but you're actually seeing greatest companies in the making in this period of time. I'm just going to give a couple examples of whatever you are seeing across our portfolio companies. Vast majority we are investing are really just traditional businesses. Many of them face some headwinds, like we bought the largest shoe retailer, and in COVID, people wear slippers. They don't need shoes, high heels. And we bought a mattress company, and then the real estate slowed down dramatically. So in both cases, we're actually seeing companies doing very, very well, leveraging technology, being very aligned with their employees, have long-term plans with their suppliers, with the distributors. That reminds me When I started my career of 1998, was one of my mentor, he named Charlie Ellis. He wrote a book. He was on the chairman of Yale Endowment Investment Committee. He wrote a book called Winning the Loser's Game. That he basically saying that in the sports of tennis, if you observe, you don't have to be the strongest. All you have to do is be consistent, have steady hands, and wait for your opponents to have enforced errors. And in this environment, I'm trying to really tell my management, you don't need to be super smart. All you need to do is be consistent, be long-term, steady hands, and do the right things. Actually, you can have a lot of market share to gain. And I'm seeing that across portfolio companies, they are doing a very good job. And I really respect those people who can walk through those difficult times and show leadership and continue to grow. And you know what? It's cyclical. So when it comes back, they are much stronger and bigger companies.
Yichen, you're a classic buyout person, well ahead of your time in mainland China. I'm sure you've got lots of war stories, but as you look back over your journey, what would you say are some of the highlights that's worth sharing here?
I'm actually not sure if I have a whole lot of highlights. In fact, my journey, the overall CITIC Capital journey, is somewhat unique in the sense that one, in terms of shareholding, we started with a SOE backer, and so that over time obviously has evolved, and now we are, we have a mixed ownership even with new shareholders. I mean, not so new anymore. It's 8 years now with Tencent and Qatar, and so. That's why we launched a new brand called TrustStar Capital, just to distinguish, especially in front of our international investors, that this firm is actually management controlled. Second aspect is on the strategy part. We started on a buyout strategy probably earlier than most. A lot of it is because of DNA, because I joined CITIC Pacific in year 2000 and started CITIC Capital in 2002, but because I was doing corporate investment, so the focus was more on buyout. But we honestly, if looking back, clearly we had the wrong strategy. That's why it's not a highlight. It was a struggle, because we were trying to do buyout in a largely growth-driven market. Now, but we toughed out, we persevered long enough. The market is finally coming back to our strategy. So it started about 10 years ago when the economy started to slow down. You initially see value adjustment in the public market. That's why I started doing public to private deals like Focus Media and a lot of those type of deals, and then start doing corporate carve-outs like McDonald's and so on and so forth. So that's the second aspect on the strategy front. I think the third aspect is what we are all facing now is that the Chinese market on the private equity side, it's clearly, obviously it was on a great run. You're basically overlaying factors like, tremendous economic growth, very cheap capital from international investors, and the great entrepreneurs. You basically have all the stars who are aligned to create that sort of a return. But we all know all good things come to an end, and clearly we're seeing now is the sort of the maturation of the Chinese market. Now, unfortunately, when it happens on the downturn, it's it's perfect storm. On the other side, you have geopolitical tension, you have slowing growth, you have regulatory challenges, and the shortage of capital. It all happened at the same time. So you went from the peak straight down. And that adjustment itself may make people lose sight of the fact that Chinese economy, Chinese private equity market overall is due to mature, given the GDP growth is no longer 10%. We're talking about 3 to 5%, and this is the market in which buyout strategies should be the main play, which is the case in the U.S., in Europe, in all the developed markets. We all know buyout strategy account for 70–80%. In China, at this point, it may be 20%. So clearly, I think that buyout strategy is finally, maybe it's the time for it.
Yichen, going back to you again, what do you see on the ground right now in terms of investing in the mainland? Because I think for a lot of the audience here who may not have a chance to head to the mainland this time as they come through for this event, what are you seeing on the ground, sort of the challenges today in deploying capital in private equity, and what are some of the green shoots that you're seeing right now?
If you want to talk about challenges, how much time do you give me? So, but in all seriousness, I think that clearly there are a lot of challenges. I'm not going to go into them. I mean, the Western press certainly talks to them enough about it. But the interesting thing is, if you look at the data on the ground, for example, we own McDonald's, so I get daily data from it, and even this year, I see over 20% growth, and this is over 5,000, close to 6,000 stores. And you look at all the other data, travel data, it's above 2019 levels, and there are many positive signs. What's weighing down the economy clearly, first and foremost, is real estate. And I think it's still going to take, the overall economy is going to take some time to, trying to wean itself off that. But the basic consumption is by and large intact. So that's the first comment I want to make about the economy. Secondly, in terms of green shoots, from an investment opportunity perspective, we're seeing a lot of corporate carve-outs, multinationals wanting to reduce their exposure in China, but do not want to leave completely. So they are looking for partners who can help them navigate better, or at least who can deflect some of the geopolitical tension better for them. And then you also have a lot of Chinese groups which are over-leveraged and need to reduce the leverage and sell assets. And you also have generational transition that the first generation of Chinese entrepreneurs, need to retire. And like, Chinese families in Hong Kong, in Singapore, in Taiwan, which tend to keep the business in the family. In China, unfortunately, the succession option is very limited. You have one child. If that child doesn't want to do it, you don't have a whole lot of option other than selling it. So those are the opportunities that I see.
Oh, that's great insights. Lei, let's chat a little bit about your portfolio. I'm sure as you go around, everyone wants to know how resilient your portfolio is. How do you get better resilience in it? Are the valuations where they are right now, the bottom? How do you ensure that there isn't any further downside? I think you know the drill, right?
Yeah, sure. I wanted to quickly just follow up on Yichen's point on the opportunity set before I address my portfolio. I was advertised for Asia, I guess. In addition to the opportunity set Yichen elaborated, I would add that private credit is really also taking off in Asia. You think of the opportunities that Yichen talked about. Some of them need transitional capital. Some of that need intergenerational. They are not sure that they want to give out all the equity yet, but they need partners to work together. And people say, hey, in the US, private credit earns so high return, why Asia? I would argue that Asian company much less levered than US counterparts. Actually, they are well positioned, and many of them manage the balance sheet really very conservatively, and there's higher growth potential. So I would say private credit, performing credit, the new growth area for Asia. The other is special situations. And as we know, there's more and more inter-regional collaboration. There's a Chinese company going to Southeast Asia. There's a Korean company building business in America. There's all number of opportunities that actually being a credit investor or in some difficult restructuring, you could be a part of that. So we are seeing, I come back to the resilience question, we are seeing the lot of toolbox just start to open for the best company, for the entrepreneurs, for the opportunities that if you do a good job, there's a lot of things that could be available. That was we were just purely, Asia was so much equity orientation. There's not so much other toolbox. I think we're going to help those companies grow.
So Chip, I'm going to turn the questions a little bit to all the challenges the rest of the three of us here face as we go out to speak to the investor market all around. And, main question is, North American buyout has been such an attractive market. Why should we even bother putting money into Asia or China? If you give us your answer, we'll all use it now.
So you look back, hindsight says, right, over the last 20 years, U.S. markets, amongst major markets of the world, perform better than anywhere. So hindsight would say, put all your money in that. Then it would say, actually, it's really like just tech. Had you just done that? And then you say, no, 30 years ago, you should have bought one stock and gone home. And the reality is, that's not the way the world works. You don't look at it in retrospect. You've got to think about it ahead. And sort of the point I made earlier is the secret to preservation of wealth and managing money over time is diversification. We all have a habit of thinking we can predict things. We don't tend to actually be very good at it. And so if I think about us as a firm, we have now a 50-plus year fund investing record. The argument is more about consistency over time, and you achieve that through diversification across geography and sector and vintage and other things we're all learning. And I think the point I was trying to make earlier is, yes, China and Asia are going through their dimensions of complexity at the moment, but the reality is for a place that's more than a third of global GDP and probably twice that of growth, for most people, I'd say it's like 10% plus or minus of where people's portfolios are. So the argument is more about diversification than it is necessarily trying to pick. And again, my point is not the U.S. dynamics are positive, and it's come out of COVID probably higher higher trend to GDP than sort of anywhere else in the world, and the markets are great, and the companies themselves are quite global. One of the things people don't think a lot about is some portion of positive U.S. performance is that the corporate sector itself tends to play to great global trends. Again, this company being a really good example of that. So I think the argument to stay present and stay invested in Asia is a powerful one. And I think what we're all living through as investors is frankly going to be a real sorting out. There will be people who won't make it through this. And I think those places that can stay committed, think about how the environment's changed. I mean, China in particular was a very momentum-centric environment. I think Lei and Chin both said it in different ways. And a lot of that sort of has been given back. And so if you look over the last 20 years, 10 years it's probably flat, 20 years it's probably barely positive. I think that shift is coming as people sort of understand more the mature private equity story that Yi-Chen talked about, as we better understand how China and Hong Kong capital markets evolve in ways that create more opportunity and more choice in terms of how our own private equity industry evolves. So I think that's the core story about why it still remains relevant to be present.
Can I just quick comment?
Sure.
So I can't pass this opportunity to at least make a negative comment on the U.S. market, private equity market, is because if you look at it, even in the last 20 years, I think a significant part of that return was driven by leverage, probably up to almost, I don't know, there's one study saying it's 50% of return actually driven by low interest rate. And now interest rate is back up, so a major source of the return is gone. On the other hand, this is the first time that the interest rate in China, it's in 40 years, it's lower than in the US. And even for the foreseeable future, because there's lack of inflation in China, so there's interest rate is likely to remain low in China. Hence, even from a leverage perspective, you could see more return out of it, on private equity from China rather than from the U.S.
I was going to second Etienne's point. I mean, obviously, we've got sizable presence and but the reality is, I've been at Warburg almost 40 years, and Howard Marks made this point earlier. I've probably lived through 25 years of declining rates and 15 years of low rates, and many people haven't even seen any of those cycles through all of it. And as a private equity investor, you get to make money because you grow the underlying earnings of what you buy, you accelerate that through use of leverage, and you buy and sell at different multiples. And the third, to Etienne's point, has been a very powerful driver to the asset class for a pretty extended period of time. And we've all talked about over the last couple of days how that feels more at risk and may actually go the other way. The leverage thing matters less. The first is going to matter a whole lot more. And I think that's the, just as we talk about sorting out here, I think that's the sorting out that's going to take place in the U.S. Who's creating real businesses that are genuinely profitable? And so I think there's a different set of challenges for investors that are at play there. And I think Etienne's, sort of spot on.
I would add what Chip said earlier on this, a couple of things. One is if you look at the Asian growth engine, I think in the past, there was a lot of demand driven. There was, now we are seeing supply side consolidation. Second, we are seeing the management becoming more mature. I just met with a management team, actually, Pan-Asia regional healthcare company, actually owned by you guys. But I was really impressed with the CEO. I mean, the way they penetrate, because Pan-Asia markets are fragmented. There's different segments, how they are thoughtful, how they grow the business. I would say you got this conservatively leveraged company, very little, but really still enjoy the high growth. I think that's the beauty of Asian companies. They are mostly well-managed balance sheet, even private equity-owned companies, by the way, and growth. And I was say blown away by the growth of management team over the years, that we are really seeing management talents now than before. I don't know what you guys think. It's like 10, 20 years ago, you don't see as much. Now you're seeing really good talents. Particularly, I was really impressed with that particular CEO or the representation of the group who can be regional, who can be penetrating different markets, who also understand leveraging technology for very traditional businesses. Like this, it's not like rocket science. It's not like AI. It's not like, it's just very traditional businesses. I would say I'm really impressed.
I'll make a comment. Actually, something that Chip said years ago. It still resonated with me. Chip was making a comment that this is probably 20-some years ago. He said, okay, the perfect world for private equity investing is you have the natural resources of Russia, and you have the government of China, and you have a management talent from India. But over time, what we have seen in China is, given how many multinationals have come to China over the last 30 years, and the management talent they have trained, these days, for us, it's night and day. Now the management talent pool, the operating talent that you can recruit, it's very deep.
This panel is fascinating. They don't need a moderator.
I continue. I still want to add that I would say that yes, you could have the best vintage in this period of time. That you, as you said, you got to get a declining valuation entry in. You might have ended up the best vintage.
That is the best summary, because we needed to rebut Albert Go's 5.5% interest that he was happy to live with. He was trying to put us out of business. Okay, let's turn to crisis and ecosystems that kind of get secluded by it. I remember the 08 crisis, and I was getting depressed on the portfolio that I was running at the time that was, multi-geography. But the place that I had my solace was China, because China kind of defied gravity then, right? Well, we now have another sort of ecosystem in India that seems to be having its, it seems to be kind of shining outside all of these problems. Chip, you've built a business there. You've been there for a long time. Talk a little bit about that. Talk a little bit about how you moved Jeff to build the Southeast Asia business and how you sort of see those markets.
Sure. I've sometimes said if, China's one of the great economic transformations, India's always been to be a fascinating kind of nation-building exercise relative to the diversity of population across, ethnicity, language, and the like, and to be held together in the way that it has. The interesting observation I had about India when we first started there was, unlike almost anywhere else, as it sort of came out of its economic reform in the early 1990s, it had an incredibly high real cost of capital as a result of sort of administered interest rates at the time. And my observation as an investor is it did two fascinating things. One is assets tended to trade quite cheap, reflecting that. The more interesting one to me was that management teams there had grown up with a high cost of capital, which meant that it was scarce and dear, and therefore they were very good at operating businesses with that and understood return on capital. In many ways, a little bit the opposite of what, kind of Elaine and we're talking about in China, where the flood of capital kind of created a different dynamic. And so as a result, I think, that's obviously played out over the last several decades, but the management talent pool that has longer history in India, combined with sort of this discipline around understanding cost of capital, I think one of the reasons that the Indian stock market is one of the few, if you looked at over the last 10 years or 20 years, that would look pretty similar to what the U.S. was. It would be competitive in that sense. And so when you look at it, it's stunning to look over the last 10 years where you'd probably say, the U.S. and India look more like double-digit things. China looks like it's sort of flat. But I think this sort of management talent depth and issues around cost of capital are sort of the underlying elements to it. And I think it sort of ties back to the conversation that was happening earlier, in that I think the generation of entrepreneurs that are now sort of growing up in China and across Asia are sort of now learning that lesson. And we're now seeing them understand that capital isn't free. And there's a version of this that's happening in the U.S. as well, right? We've lived through a world where nobody asked anybody for the last 10 years what profitability was. We were worried about growth and revenue, and capital was free. And while we all understand that world's changing, the reality, it takes management teams time for that to change. So I think, in many ways, kind of India led on that topic, but I think it's now interesting to see what's happening in China and especially in Southeast Asia, where there's this next generation of entrepreneurs coming that are more mature, that are deeper, more professionalized, better understand sort of some of the dynamics around business. And I think, I think in Southeast Asia, you see differing versions of it. You well know it's hard to generalize. It's 10 different places with many different dynamics around it. But there's a series of pretty interesting stories as you wander through Indonesia and the Philippines and Vietnam and Singapore. We're celebrating our 10th anniversary tomorrow in Hanoi of being there. And I think, part of what I think stays interesting about Asia, besides the other elements we talked about, is kind of this next generation. It's of entrepreneurs broadly that I think add to the dimension of the story.
So we're down now to our last couple of minutes, because all of you lost me time on the other questions as you went off on your own. I have no time for any of all of your questions, because we're gonna finish off with this. This is the last panel of this really, really important gathering of everyone. Your 2024 predictions around the Asia private equity markets and where it's going to go. Yi-Chen, we'll start with you.
Okay. I think it's still going to be a tough year in China because, the growth driver quite a bit of it, to win the economy of real estate and to, plug that hole with other industries is going to take some time. And but transformation at a micro level is happening because clearly the businesses will have to do with much less resources or capital. So I think 2024 is probably a year of recovery still. And the overall fundraising environment is still very tough for China. So, I'm just trying to keep a steady footing on the ground, and I don't have lofty aspirations.
Lei?
Building resilience for the existing portfolio, best vintage for private equity in the next funds, I think, next couple of years to invest in Asia, and the growth of Asia as across asset classes beyond private equity, private credit, real assets, infrastructure. We're going to see a building up of new asset classes in the private space.
Wonderful contrast between those two in terms of the outlook. Where are you, Chip?
I think the world is still coming to grips broadly with what I think are two big changes that none of us have seen in 40 years. We all touched on them. It's sort of what happens to the inflation rate story. And it's not that the new world isn't investable and manageable. It is. It's the transition from where we've been to there that will be painful. And the other is, the geopolitical frictions that the lack of them over the last decades provided a certain oxygen to growth. And I think now there's a set of challenges associated. I think for Asia, it is likely to be a more extended, what I'll call great sorting out. And I think this will test who has staying power of capital and confidence of investors to be able to manage through, who recognizes the reality of how the environment has changed and retools and repurposes and rethinks the strategy of how to be here and takes advantage and lays the seeds for what ultimately is probably another generation of pretty interesting, successful stories that will come out.
Well, we've run out of time. It's now with me to thank our panelists today and to thank our hosts, the Hong Kong Monetary Authority, for putting up such an amazing show for us this last couple of days. We hope that you will have us back. I know these people were very ill-disciplined. I followed all the rules that you set me. I read the full memo that you provided. Please have me back next year. With that, thank you very much.
Good end. Thank you very much. If you could take a photo before we go to our final speaker of the day to close it out, gentlemen. Very quickly, pose and smile, gentlemen. Good end before you go. There you go. Excellent. Well done. And we do have one more speaker coming. Following our last speaker, we will have time where you can hang out. You can do a little more networking. There will be coffee and refreshments served. So, you can extend the week. You can extend the experience just a little bit longer. And after these gentlemen leave the stage, I believe we are going to have a little bit of a. Are we going to have it? No, I think we're ready for action. Ladies and gentlemen, the host with the most is saying he's ready to go. He doesn't need the stage cleared. He's always ready for action. He's had he and his team have produced the past couple of days at the Global Financial Leaders Investment Summit. They've done a great job. Let's have the final word from the Chief Executive of the Hong Kong Monetary Authority. Ladies and gentlemen, make some noise for Mr. Eddie Yu.
We're coming to the close of the summit, and I'll be very brief because we're eating into your lunchtime. But thanks very much for coming over. In fact, in the last 2 days and up to the last panel, I keep learning a lot. And I hope that you all enjoy the conversations, the discussions, as well as I do. The world is going to remain complex. We're not going to solve the world problem, but I hope that after the 2 days of discussions, you will have a lot more sort of thoughts about how to thrive in this really complex world. At least you understand the dynamics a lot better, the opportunities, and think about how to manage your risk as well. So it's been really helpful in sort of navigating through this complexity in the next few years. And the conference, the summit, will end here, but I know that many of you might be staying for a day or two. Go and talk to your clients, your friends, your teams, your partners, and really get to understand Hong Kong better. And through Hong Kong, understand the China-Asia opportunities better. This is the place where you can actually do business for Asia, for China, not just in Hong Kong. And I hope you have a very good day, and I hope to see you all soon, all our friends and partners, very soon in some parts of the world, Hong Kong, New York, or London. Thank you very much.
Thank you very much, Eddie. Ladies, you came, you saw, you now go forth and conquer. I've been Andrew Work, and thank you on behalf of the Hong Kong Monetary Authority, Securities and Futures Commission Hong Kong, and the Hong Kong Academy of Finance. I'm Andrew Work. Bye-bye.